Good morning. As the Market Risk Advisory Committee designated federal officer, it is my pleasure to call this meeting to order. Before we begin this morning's discussion, I would like to turn to the commissioners for opening remarks. We will start with Commissioner Kristen Johnson, the sponsor of the MRAC.
Good morning and welcome to our final meeting for the MRAC for 2024. I'm delighted to have all of you who are here in person and have joined us virtually as well. We are hopeful about continuing a thoughtful conversation and important developments of the committee to advance a number of potential risks facing futures and derivatives markets. Today, we continue the long tradition of the MRAC's engagement with the Commission. Its valuable insight into the concerns that shape the stability and integrity of global derivatives markets, and its collaboration toward developing ways that the industry and the Commission can prepare for and mitigate the most critical risks facing our markets today. The work of the MRAC influences the creation of regulation, industry standards, and best practices that govern global derivatives markets. The committee provides valuable thought leadership on critical issues that impact citizens and businesses in every corner of the world and shape the development of the direction of travel for our markets. We have a full agenda for today's meeting, and we're grateful to many distinguished speakers and MRAC members who will share their expertise with us and create a diverse set of viewpoints for pressing issues, not only in our markets and the market participants in our markets, but the economy more broadly. The MRAC will introduce 3 formal recommendations, reports, and presentations that offer insightful guidance on a number of matters. But first, this morning, I'll pause in my remarks and save what would be the longer version of these abbreviated remarks for the closing, if possible, based on our agenda, because I don't want us to miss the opportunity to hear from a very special guest, the Honorable Josh Frost, Assistant Secretary for Financial Markets at the U.S. Department of Treasury. Following Assistant Secretary Frost's remarks, we'll explore the U.S. Treasury cash futures basis trade. A range of market participants and experts that have joined us, as well as members of the Market Structure Subcommittee, will present recommendations on effective risk management practices. We'll then turn to a number of important questions related to cyber threats and third-party service providers that are increasingly important and we increasingly rely upon across the businesses in our markets. MRAC has focused on cyber threats in our markets since its creation. But in March of 2023, MRAC held a first-of-its-kind public meeting to discuss the then-recent cyber disruption that affected derivatives clearing markets. This would be the cyber events that impacted ION. Today, the CFTC MRAC Advisory Committee advances proposals aimed at addressing cyber risks that may threaten market infrastructure and business continuity for several of our largest market participants. Following these presentations and the recommendations offered by these subcommittees, we'll hear from 2 subcommittees that will not have recommendations but offer really critical insights into, in the first instance, climate-related market risk, and in the second instance, the future of finance, but more specifically, artificial intelligence and the integration of artificial intelligence into financial markets. I'm going to pause here and again resume sort of a more fulsome description of some of the remarks, time permitting at the end, but certainly the published 8-page version with 24 footnotes of my remarks will be immediately available on the CFTC's website for those who are eager to hear all the details. The agenda for today's meeting is robust, as I said at the outset, and I could not be more enthusiastic and excited to serve as sponsor of the MRAC and welcome each of you here. Thanks, Danny.
Thank you. We will now turn to Commissioner Goldsmith-Morero if she wants to make any brief remarks as well.
Well, it's so nice to have everyone here, and so many of you came in person, which is terrific. I haven't seen some of you for a while. It's very nice to have you. So welcome back, MRAC members. Thank you so much for your service. Welcome our distinguished speakers today, and I'm so pleased to see Commissioner Johnson leading today's meeting. I want to thank her for bringing us together today, and also for her sponsorship of MRAC and all that she does for the Commission. Welcome back to the CFTC, Josh. I should say Treasury Assistant Secretary Frost, for an update on Treasury's work to build resilience in Treasury's markets, which I remember you first discussed at a GMAC meeting with us. So I look forward to his remarks, and also the MRAC members sharing their perspectives on those markets and effective risk management practices. And as a long-standing market regulator at the SEC and the CFTC and Treasury, I have direct experience in overseeing how Treasury markets are foundational to the U.S. financial system. They are the most liquid and deepest markets in the world. The U.S. Treasury futures market, which the CFTC regulates, had an average daily trading volume of $750 billion. And in the CFTC's experience, central clearing in the futures market has reduced systemic risk and improved transparency. And during a time of stress in Treasury markets, the Treasury futures markets remained resilient. So I've talked with Assistant Secretary Frost and others about how the futures markets can serve as a model for the Treasury markets. And Treasury has advocated for an expansion of central clearing, which the SEC has been working on. I look forward to continuing the dialogue with industry on these markets and continue exploring how we as regulators can effectively oversee Treasury markets. As a sponsor of the CFTC's Technology Advisory Committee, I want to touch on two areas on the agenda today that the TAC covers: cybersecurity and AI. First, on cyber resilience, I should say on both of these. I believe that regulators are at their best when they're engaged in ongoing dialogue with registered entities and other stakeholders, just to understand their perspectives and challenges and what they're doing to meet those challenges. I've had many conversations over the last 2 years with our registered entities to understand their perspectives on the challenges of cybersecurity and the steps they're taking. This dialogue, the ION attack, the TAC's work on the best practices from the ION market, also generally on cyber resilience. My conversations with my fellow commissioners have all informed my work in leading the CFTC staff to draft the CFTC's first ever proposal on operational resilience for swap dealers and brokers, which was adopted in a 5-0 vote from the commission last year. And today we welcome a number of speakers to give their perspectives, including Treasury DAS Todd Conklin, who is a member of TAC, and has presented to TAC on the ION market cyber attack and Treasury's response, and participated in TAC's exploration of how to promote cyber resilience. And he and I talk often about cybersecurity, and I welcome him back to the CFTC as well as the other speakers today. I understand that DAS Conklin will also update us on Treasury's efforts on AI, which he has discussed at earlier TAC meetings. DAS Conklin is one of several well-respected AI experts that serve on TAC, and he contributed to drafting TAC's 65-page report entitled Responsible AI in Financial Markets, Opportunities, Risks, and Recommendations that we issued in May. And my understanding is that Treasury's work dovetails with the TAC report and the recommendations in it. The TAC report was the first comprehensive report on AI in financial markets. I'm proud of the efforts of TAC to acknowledge that AI has been used for years in U.S. markets, and that we're just at the forefront of understanding how generative AI will be used in markets. So this report recognizes the opportunities that the evolution of AI presents, while balancing the need for risk management, particularly in areas like AI-enabled market manipulation, cyber attacks, and fraud. Responsible AI is generally known to include properties of privacy, explainability, transparency, fairness, and robustness. And in my discussions with our registered entities, there's agreement these are important properties, but they face practical challenges implementing them. So I focused on foundational best practices like governance, development of expertise, training, testing, and consideration of the role of humans. In making recommendations to the CFTC in the report, the TAC felt it important not to get too far ahead of use cases that are not yet in place, while addressing the need for responsible design and deployment of AI. The recommendations in the TAC report are high-level principles-based rather than prescriptive. So these include for the CFTC, first, regulatory and dialogue and outreach with our regulated entities. Second, consideration of requiring NIST AI risk management framework, just like we do for cyber. Third, developing an inventory of existing regulations that already apply to AI, along with conducting a gap analysis. 4, aligning any CFTC policies with other federal agencies. And 5th, CFTC engagement and development of technical expertise. And the CFTC is proceeding along implementing some of these recommendations. I have been and will continue to be engaged in dialogue with our registered entities to understand their perspectives, challenges, and efforts in all of the areas that are being discussed today. That's my shameless plug for the CFTC TAC AI report. But I look forward to hearing from all of you today and look forward to the discussion. Thank you again for all of your service, and thank you to all of the speakers who are here today.
Thank you very much, Commissioner. We will now hear opening keynote remarks from the Honorable Josh Frost, Assistant Secretary for Financial Markets at the U.S. Department of Treasury.
Thanks, and thank you, Commissioner Johnson and Commissioner Goldsmith-Romero and your colleagues at the CFTC for the invitation to speak to today's meeting of the MRAC. I'm going to endeavor to be brief because I know you've got a packed agenda that includes many topics of keen interest to us at Treasury, including central counterparties and the cash futures basis trade. So as this committee well knows, the Treasury market plays a number of critical roles in the financial system. The Treasury Department, we use Treasury securities to finance the U.S. government. The Federal Reserve uses Treasury securities as part of monetary policy implementation. Treasuries are also used as a major fixed income asset for investors around the world and serve as collateral for a wide variety of transactions. They're also used as a reference benchmark for global asset prices. The Treasury market can play these roles effectively, in part because it's the deepest and most liquid market in the world, and we're working across the official sector to make sure it stays that way. So the Treasury Department, along with its partners in the Interagency Working Group on Treasury Market Surveillance, or IAWG, has been evaluating policy options to enhance the resilience of the Treasury market. Though our work spans 5 different work streams, one key area of study is the expansion of central clearing, which should enhance and standardize risk management, as well as improve intermediation capacity. About a year ago, after substantive engagement with market participants and other regulators, the SEC finalized rules to require central clearing of certain Treasury securities and repo transactions. Certainly a big change, as the new mandate will lead to a significant increase in the volume of transactions to be centrally cleared in cash securities, but especially in repo. My colleague Nellie Lang, Treasury's Undersecretary for Domestic Finance, gave remarks on this topic last month, and I wanted to highlight just a few themes that she discussed. While expanded central clearing may result in increased costs to implement risk management and other operational requirements, it's important to distinguish between private costs to individual market participants and systemic costs to the broader financial system. Expanded central clearing that requires market participants to internalize costs of better risk management should prevent excessive risk-taking and reduce systemic risk. Market participants are working hard toward deadlines that the SEC established: additional clearing of cash securities by the end of 2025, and of repo by the end of June of 26. And by March 31st of 25, covered CCPs need to implement customer clearing models and segregate house and customer margins, among other requirements. There are many open issues to ensure that market participants are ready, including around market structure, client access models, accounting, and regulatory capital. I encourage market participants to continue working through these issues to ensure a smooth and successful transition. Now I'd like to turn briefly to the cash futures basis trade. So I understand that today you'll be discussing a paper on this topic. The cash futures basis is a topic that we've been studying at the Treasury Department as well. At its first meeting of 2024, the Treasury Borrowing Advisory Committee, or TBAC, presented to us on this topic, highlighting the position sizes, motivations, and strategies used by different types of investors in Treasury futures. The presentation highlighted the importance of dynamics on both sides of this trade. That is, both the asset managers who are long futures as well as the hedge funds who are short. Asset managers may prefer futures to repo for operational ease, but also because futures do not result in the interest expense reporting that repo does. Hedge funds are in the basis trade opportunistically, reacting to the pricing differential created by asset manager demand and using leverage to enhance returns. The basis trade supports Treasury market functioning in normal times by tying together cash and futures markets, a linkage that was highlighted by the IAWG as an important goal, and by serving as an important source of demand for Treasury securities. However, the basis trade is typically highly leveraged. Research has highlighted that the leverage arising both from zero haircuts on bilateral uncleared Treasury repo offered to hedge funds and from long futures positions at asset managers. Hedge fund leverage in this trade may be mitigated by portfolio and cross-margining, not reflected by the zero haircuts on repo, but these practices can be opaque. While reported haircuts on repo may not fully reflect the leverage of the overall trade, a new data collection from Treasury's Office of Financial Research on bilateral repo transactions and the SEC's central clearing mandate for repo both aim to improve transparency and standardization, providing us with some market-based discipline to prevent excessive leverage from building. As the basis trade remains sizable, it is important for regulators to continue to monitor leverage and to balance the benefits of leverage for repo versus resilience in periods of stress. So thanks again for having me here today, and thanks for the great work of this committee on these important topics. Thanks.
Thanks so very much, Assistant Secretary Frost. We appreciate you taking time to join us. And to echo Commissioner Goldsmith-Romero's sentiments, thank you so very much for your service. I'll hand the meeting back over to Danny.
Great. Thank you again very much. Before starting our discussion, there are a few logistical items that I've been asked to mention to committee members. Please make sure that your microphone is on when you speak. This meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience can hear you. If you would like to be recognized during the discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand, and Chair Crichton will recognize you and give you the floor. One housekeeping note, if you're arriving late, we have a name card up here, and my colleague Chris can help you with that. If you are participating virtually, I would like to be recognized during the discussion for a question or comment, or if you need technical assistance, please message me or my colleague Chris Lamb within the Zoom chat. We will alert Chair Crichton that you would like to speak. A few logistical items for speaking on Zoom. Please identify yourself before you begin speaking and signal when you are done speaking. Please speak directly into your microphone for optimal audio quality on the webcast. Please unmute your Zoom video before you speak and mute again after you speak. And please turn on your camera only when you are engaging in discussion. If you are disconnected from the Zoom, please close your browser and enter Zoom again using the link previously provided for today's meeting. We will ask speakers to keep as close as possible to time. We will hold up a 2-minute or 1-minute time card indicating that you have either 1 or 2 minutes remaining to finalize your remarks. For virtual speakers, we will send you a message using the chat function as a reminder as well. Now, before we begin, we would like to do a roll call of the members participating virtually so that we have your attendance on the record. After I say your name, please indicate that you are present and then mute your line. Biz Chatterjee.
Present.
Thank you. Elizabeth Kirby.
Present.
Thank you. Purvi Maniar. Andrew Park. Edward Dasso.
Present.
Thank you. David Horner.
Present.
Thank you. Eileen Keeley.
Present.
Thank you. Derek Kleinbauer.
Present.
Thank you. Chip Lowry.
Present.
Thank you. Craig Messenger.
Present.
Thank you. Marnie Rosenberg.
Present.
Thank you. Suzanne Sprague.
Present.
Thank you. I'll pause for 1 minute in case there's anybody that I might have missed. All right, hearing none, thank you very much. I will now turn it over to Chair Crichton.
Thank you. Good morning. Nice to see you all. Today, as Commissioner Johnson indicated, we will engage in discussions involving the Treasury cash futures basis trade and effective risk management practices, recommendations to enhance CCP risk and governance, both in the area of cyber resiliency and third-party service providers, and for the use of legal entity identifiers. We will also host a discussion of issues surrounding the introduction of several emerging technologies such as artificial intelligence, the development of the carbon credit market, and other matters of climate-related risk. Our first presentation today comes from the Market Structure Subcommittee. First, we'll hear perspectives on Treasury markets from 3 panelists. Deirdre Dunn, Head of Global Rates, Citigroup, Chair of the Treasury Borrowing Advisory Committee. Scott Rofi, Global Head of Rates, Macro and Commodities Risk, Millennium, also a member of the Treasury Borrowing Advisory Committee. And Dave Rogel, Managing Director of BlackRock, member of the Treasury Borrowing Advisory Committee. Next, we'll hear from the subcommittee's recommendations on the Treasury cash futures basis trade effective risk management practices. We'll hear from the following members of the subcommittee: Nate Werfel, Head of Market Structure, Bank of New York Mellon; Alessandro Coco, Senior Policy Advisor, Federal Reserve Bank of Chicago, on detail at the U.S. Department of the Treasury; Tim Cudahy, Managing Director and Group Chief Risk Officer, Depository Trust and Clearing Corporation; Dave Bowman, Senior Associate Director, Board of Governors of the Federal Reserve System; and Jennifer Hahn, Chief Counsel and Head of Global Regulatory Affairs, Managed Funds Association. Following these remarks, we'll have open discussion from MRAC members. I'd like to turn it over to the first panel.
So I think that means that I get to kick things off. So thank you so much for having us. I'm Deirdre Dunn, Head of Global Rates at Citi. And as mentioned, I have the honor of serving as the chair of TBAC. So I have a few opening remarks, and I'm joined by a couple of my TBAC colleagues today who will also comment. The scale of the US Treasury market has increased notably over the past few years, both in absolute terms and in terms of the number of auctions, size of auctions, really all metrics. It is often noted, however, that primary dealer balance sheet has really not kept pace with this expansion. And I think as a result, we've seen some changes in the way liquidity is managed and shared throughout the system. This has driven an increased focus on the broader Treasury ecosystem and market functioning. As Josh mentioned, the IAWG has done significant work and great work to improve the resilience of the Treasury market. More broadly speaking, in the market, we've seen the introduction of the standing repo facility and also the launch of Treasury buybacks, both for cash management and liquidity purposes. And as Josh mentioned, the build out of central clearing, among many other things. Nonetheless, in recent years, we have also seen a drift in the appetite for US Treasuries from somewhat less price-sensitive buyers to, on balance, more opportunistic and price-sensitive investors, including hedge funds. In the fall of 2023, these discussions turned increasingly towards what is often referred to simply as the basis trade, or buying cash treasuries versus selling futures, expecting return accretive convergence between the two. Some opportunistic investors can be active participants in this strategy to earn the premium implied in market pricing. Additionally, in conjunction with this strategy, many market participants employ leverage to enhance returns, and this leverage is often, in turn, provided by primary dealers. Much of the focus and reporting last year, at least initially, really centered around the opportunistic players and the scale of leverage employed in this strategy and what that possibly meant for the Treasury market overall. At the time, very little of the reporting really focused on why this opportunity, or effectively this price discrepancy, existed to begin with. As Josh mentioned, earlier this year, TBAC welcomed the opportunity to review the ecosystem in more detail, with a focus on really what is a symbiotic relationship between the asset managers, who are willing to pay a premium for Treasury futures, and the hedge funds, who opportunistically take the other side of the trade. The Treasury market is, as already mentioned here, foundational and very important to the broader financial market and ecosystem. So it's very important for all of us to understand the dynamics of the various market participants and any meaningful changes in structure. But it's also, and leverage, but it's also important to remember that the role that's played here by opportunistic players or hedge funds can be a positive one, as they also support the conversion of effectively what Treasury needs to issue, cash securities, to what some of the end users have appetite for in futures form. TBAC was very glad to be a part of sharing a more complete narrative of this dynamic with the public, and we appreciate the Market Risk Advisory Committee's efforts to do the same. As I mentioned, I'm pleased to have two of my TBAC colleagues here with me who can help to provide some more specific insight into these dynamics. So with that, Dave, I'm happy to pass it to you.
Thank you, Deirdre. So I'm Dave Roble. I'm a portfolio manager at BlackRock. Work closely with Deirdre and Scott on TBAC, and I manage some of our multi-sector fixed income mandates. So I'll talk about, the way I'll structure my comments are I'll talk a little bit about how we use Treasury futures in our portfolios and Treasuries, and then try to relate that to the structural position and how I think that's evolving over time. The first thing I'll note is, we use Treasury futures as you would expect to manage interest rate risk in our portfolios, to take positions on interest rates, to take positions on curve, and to hedge interest rate risk in different parts of our portfolios and different fixed income securities and sectors. And when you think about those use cases, they're kind of what you would expect, and over time, you wouldn't expect that to necessarily create some kind of structural position in futures. You might have a view to be short duration, you might have a view to be long duration. Over time, that position should change and should not be just one way. The third reason, or the other main reason that I would cite in how we use futures and why it might create a structural need from the asset management community, is on the financing side. And so we will use Treasury futures as a financing vehicle in our portfolios to invest in other parts of the market. And so if you think about it, you want to deploy cash out of Treasuries and into other sectors. You need to be able to manage your interest rate risk in doing that. And so we can use our Treasury allocation effectively as a funding vehicle to invest in more opportunistic parts of the market. It's important to note that not every transaction or every switch out of Treasuries into other markets will result in a net futures position. For example, if you have a 10-year Treasury that you're selling to invest in a corporate bond, that's a 10-year maturity, you shouldn't really need to have a transaction there. Or even if you have a 10-year Treasury that you're substituting into a shorter duration corporate bond, you're going to end up with a futures curve position. It's really certain types of transactions like investing in floating rate assets or non-USD denominated assets where you might need Treasury futures from a structural standpoint. So a good example is buying a floating rate asset, selling down a Treasury in your portfolio. You need to get your duration back effectively, and Treasury futures represent a very simple and easy way to do that. And it's important to note that this process really revolves around creating more diversified portfolios, and I'll talk about that in a moment, and also leveraging our security selection expertise and credit selection expertise. This question then arises, why Treasury futures and why not use repo? The first I would note is that Treasury futures reduce the operational burden and are a simpler instrument to use. And there are many mandates within the asset manager community and institutional side that don't even allow repo. That's one reason. The second thing is term finance and liquidity are a big benefit to futures compared with repo. Third, more leverage flexibility typically, at least with some of the historical regulations. And lastly, as Josh mentioned, the interest expense issue. FINRA guidelines mandate that interest expense from repos get reported into expense ratios. And the same is not true of the implicit interest expense in futures contracts. So that presents a communication challenge for many managers. And so that has pushed some of the industry at least towards using Treasury futures, although I would note that there would probably be some structural position in futures anyway because of some of the other benefits that I mentioned, term finance, et cetera. I would say that a few other things to note on that. One is the leverage used by asset managers in this type of transformation is typically not large. So you're typically thinking about something like 10 to 20% of your portfolio, compared with the basis trade, which you're going to see multiple turns of leverage, as Scott will likely address. So it's a different dynamic from that standpoint. And the other thing I would note is that over time, and why I think you're seeing this become a bigger issue, is many of the indices that we use and other bond managers use to manage against, for example, the AG index, have seen significant increases in their Treasury weights because of the significant Treasury issuance relative to other sectors. So for example, in the last 20 years, the Treasury weight in the AG has gone from 20% to 45%. And so as an active manager, we think it's beneficial to our investors to take a more diversified approach and invest in many other sectors within fixed income. As Treasury weights has risen, the need to effectively match your duration and with futures has grown. And so one of the things that you could have seen from the TBAC presentation was that the position in asset managers on the futures side has actually grown with the size of the Treasury index and size of Treasuries in the index. So that's I think a notable driver as to why there's more demand for that. The last thing I'll note, as Deirdre mentioned, is we're constantly monitoring the costs of doing this. There is a cost above and beyond, for example, CTD basis, which ranges in the 5 to 15 basis point range, associated with things like the liquidity the liquidity premium in the CTD itself. And so it is generally paid in the last 10 years to invest in higher returning opportunities in the fixed income market and pay that financing cost. So asset managers like ourselves are willing to do that, to invest in what we think are more attractive parts of the market. I'll leave it there.
That's my cue. Hi, thank you for welcoming me to speak on this morning's panel. I'm Scott Rofi. I joined Millennium almost 4 years ago now after spending 6 years at JP Morgan and 16 years at Goldman Sachs. My role at Millennium is I'm head of rates, macro, and commodities risk. I'm also a member of senior management in what we call the Office of the CIO. Millennium has been in operation for 35 years, manages roughly $70 billion worth of capital. We're what's called a global multi-strat. That means we're engaged in a broad array of activities across all major asset classes, strategies, and geographies. We oversee over 300 portfolio management teams. Each has a specialty and a mandate to deploy defined portions of our investor capital within an established set of risk guidelines. One of the many strategies we operate is trading in the global sovereign bond markets, including the US Treasury market, where we have portfolio managers with deep expertise in treasuries and treasury futures. They're also usually subject matter experts in the markets for secured financing and treasuries themselves, and in the options which are embedded in the specification of the treasury futures contract, including the option to deliver the cheapest eligible security from many in a basket and at flexible times within a multi-day delivery window. The Treasury basis trade might loosely refer to any position in one direction in a Treasury and in the opposite direction in a Treasury future. But the amount of market risk and liquidity risk inherent to the trade varies depending on exactly how one structures it. For example, a manager might hold a long position in the unique bond in the delivery basket, which is the most probable to be the cheapest to deliver security, and then finance that holding a term repo transaction that matches the expected delivery date in maturity. That package is closest to the canonical arbitrages that are commonly described in textbooks. From there, one can imagine changing the treasury leg and or the financing leg of the trade such that it takes more market, liquidity, and financing rollover risk. One could finance the trade for a week or overnight. One could choose a bond that's very close to, but not the most probable for delivery. One could choose a bond that has a lower or even significantly lower probability of delivery, absent a very large change in market prices. How market participants interact with these choices are exercises in evaluating risk-adjusted returns, as with any market. Portfolio managers with expertise in this type of trading may also have expertise in trading relative value between several bonds without a futures leg, relative value between bonds and interest rate swaps, and other adjacent markets. As prices for these instruments ebb and flow with broader drivers, our portfolio managers are part of the constellation of activity that accommodates and transforms risk according to the business model that we describe to our investors. Transforming one form of leverage in the treasury market, the futures contract, into another, repo and swap, is an important function connecting diverse investor types, as well as supporting the liquidity of the treasury issuance itself. Let me move on from describing the trade to topics of leverage, market risk management, and liquidity management, since these topics are often discussed in the context of the Treasury basis trade. First, there's no one perfect measure of leverage, but I would describe approaches to these measures as falling into one of two categories. The first being simple ratios of a size measure to a capital measure, and then less simple risk-based assessments of the percent of total capital needed to cover potential losses in margin calls in a stress scenario. The first measures, the simple measures, are valuable exactly because they're simple. They draw attention to growth and shrink within markets. They might be indicators that markets are committing capital to growing risk factors. But the simple measures like turns of notional leverage are probably too simple to use durably for governance. They can be artifacts of changes in market structure or activity without providing enough insight into actual risks in markets. And more importantly, they tend to treat all positions as though they were the same despite vast differences in riskiness. Let me give you a toy example. I'm going to read you the 3 first percentile 5-day losses on different $1 billion size positions having the same quantity of simple leverage over the last 5 years window. The first percentile loss on a $1 billion position in the S&P 500 index was roughly $88 million. The first percentile loss on a $1 billion position in a long-only generic 5-year US Treasury was roughly $16 million. And the loss on a $500 million position in the generic 5-year Treasury hedged with $500 million of the equivalent amount of the Treasury futures contract was roughly $3 million. It's clear from this example that gross notional leverage measures don't equate to market risk. So what do we do instead? We do market stress calculations. And these calculations generally follow an established formula across market participants, including Millennium. They include 3 components. Component 1 runs simulations and scenarios on the entire portfolio to find a distribution of single-day and multi-day P&L outcomes. Statistics like VAR and expected tail loss drawn from these calculations are common risk measures at most financial firms. The one we use most when it comes to finding true leverage is multi-day stress loss. Simply put, our capital needs to be able to cover severely adverse market moves that occur over many days. While severity estimates are commonly drawn from history, it's prudent to imagine that magnitudes and correlations might not follow the historical path during future stress events and then account for that in your calculations. In respect of today's topic, this means we need to be able to simulate price changes in all of the instruments germane to Treasury and Treasury futures basis trading. We need to be able to generalize how the futures and the bonds of differing characteristics move under stress. And we need to understand how these moves may happen in tandem to prices on many other market instruments. The CFTC will be very familiar with such techniques, as they're generally the same techniques used to develop the regulatory margin models applicable to cleared and uncleared derivatives subject to CFTC jurisdiction. And they'll be the same techniques applied to mandatory clearing of repo transactions as that activity phases in, which is a good segue into the topic of stress liquidity, which is adjacent to but not the same as stress market losses. That leads me to component 2, which is that we need to be able to calculate the amount of capital needed to post margins to all counterparties and providers on a spot basis, and we need to match the models with which govern those agreements. And further to this, in component 3, we need to use those models to be able to add on a component that assumes that we're going to be called for yet more margin in a stress scenario. Importantly, this would include increased margin for both cleared and uncleared activities such as bilateral repo. We need to hold a sufficient amount of cash in HQLA to cover all 3 of the above components, and this calculation is paramount to the risk management of our leveraged activities. Of course, these calculations are not nearly the entirety of our risk management activity. The market and leverage risk of our activity is actively managed with redundancy, as with many other financial firms, on the front lines by our portfolio managers operating within risk guidelines, by business management within asset class segments who have direct oversight of the portfolio managers, by our line risk management personnel who are separate from our business management units, by members of our Office of the CIO like me, as it relates to financing and counterparty risks within our Treasury and COO function. In fact, we manage liquidity via our very operating structure. Our external investors, more than 80% of our capital, have elected to commit capital via a share class that may only be redeemed over a 5-year period. Our secured creditors have agreed to term margin agreements, and we're also a direct member of FICC, and thus can operate flexibly in all of the avenues of repo activity. Inside Millennium, we measure and analyze risk perpetually, discussing and taking risk management actions individually and collectively every day. Again, thank you for the opportunity to discuss topics related to Treasury and Treasury futures trading in the context of the hedge fund business model.
Great, thank you very much. We'll now turn to Nate Werfel, the workstream lead, to begin sharing the recommendations. Nate.
Thank you, Chair Crichton and Commissioner Johnson, and thank you to the TBAC members for the excellent panel discussion. Along with my other subcommittee members, I'm pleased to present the MRAC the work of the Market Structure Subcommittee on the Treasury Cash Futures Basis Trade, including a background white paper on the basis trade, a set of effective risk management practices, and additional considerations. This work builds on the presentation that the subcommittee presented to the MRAC in April of this year, and it's benefited from a wide range of comments from the Treasury Market Workstream, the Market Structure Subcommittee members, and engagement with firms engaged in futures and basis trades. The goal of this work is threefold. First, to better explain the Treasury cash futures basis trade, which garnered considerable attention following the dysfunction in the Treasury market during the pandemic dash for cash, with some studies suggesting that the unwind of the basis trade may have amplified the dysfunction. The Treasury market occupies a special role in U.S. and global capital markets in financing the U.S. government, in monetary policy implementation, and as a source of safe and liquid investment for participants around the world. Accordingly, risks to its function can have systemic implications, and the potential source of those risks should be well understood. The paper seeks to explain the Treasury cash futures basis trade in detail, including what contributes to the existence of the basis, including the strong demand for futures by asset managers, and the mechanics of the basis trade itself. Our second goal was to explain the risks of the basis trade, as well as the benefits it brings to the Treasury market ecosystem. In an efficient Treasury market ecosystem, economically equivalent instruments should have similar prices. In other words, the basis between the cash and futures should be small. And so too should the other bases in the Treasury market, for example, between on and off the run securities, between various Treasury financing markets, or with other similar derivative markets. This is only possible with a diverse and interconnected Treasury market ecosystem with a wide range of participants whose demand narrows these bases and helps make the Treasury market the deepest and most liquid government bond market in the world. This lowers financing costs to the government and provides a source of liquidity to holders of Treasury securities and futures. At the same time, the risk of trading strategies in the Treasury market, including those with leverage like the cash futures basis trade, should be well understood and managed, including the management of market, liquidity, counterparty credit, financial stability, and other risks. The paper explores these benefits and risks in detail. The third goal was to document a set of effective practices for managing the risks associated with the basis trade. In many ways, these effective risk management practices are not unique. There are well-known approaches to managing market, liquidity, and counterparty credit risks, including the use of modeling, stress scenarios, and margin, among others. Still, other features of the basis trade make risk management practices more unique in the Treasury cash futures basis trade, like the cheapest to deliver option associated with Treasury futures, or the importance of having contingency plans for an orderly unwind of leveraged exposure in the Treasury market. The paper describes these risk management strategies with the goal of explaining what good looks like when managing the risks of the basis trade. I'll now turn it over to Alessandro Coco to walk through the high-level content of the paper, followed by Tim Cudahy by video, to describe the risk management practices. I'll wrap up the report by highlighting some additional considerations from the paper, and then we'll turn it over to subcommittee members Jennifer Hahn and David Bowman to provide some additional comments. Alessandro?
Thank you, Nate. Today I'd like to walk through some of the key aspects of the report presented by the subcommittee. I will touch on the key components of the basis trade, then the reasons behind the demand for the long futures position, and I will conclude by enumerating some key benefits and risks of the basis trade. But first, I'd like to mention that any opinions expressed here today are my own and not those of the U.S. Treasury or the Federal Reserve System. In terms of its components, the basis trade is a position established by a trader through the purchase of a Treasury security financed in the repo markets, along with the simultaneous sale of a Treasury futures contract where the Treasury security is a deliverable obligation. A pricing discrepancy, also called basis, occurs from time to time in the markets between the Treasury futures price and the Treasury securities price. That price discrepancy provides an opportunity for basis traders to profit by selling a Treasury future and buying an underlying deliverable Treasury security. The basis trader also finances the purchase of the cash Treasury position by borrowing in the repo markets against the Treasury security they purchased. That trade is also called buying the basis, and that is what we'll focus on today. For completeness, it's worth noting that a basis trader may also engage in the opposite trade called selling the basis, where they sell the Treasury security in the cash market and open a long Treasury futures contract position while lending cash against delivery of the Treasury securities in a reverse repo. We know basis traders are typically long cash Treasuries and short futures, but what drives the long futures position? The CFTC's commitment of traders data can be used to understand which market participants are holding short and long futures position. The data shows that long Treasury futures positions are held by traditional asset managers and that they mirror nearly one by one the Treasury futures short positions held by hedge funds and other leveraged investors. Compared with repo, some market participants consider futures to be simpler to use and more transparent than repo. However, there are several regulatory, accounting, and reporting issues that incentivize some asset managers to use Treasury futures rather than to purchase and then finance Treasury securities, even though they are economically similar. By way of example, 40 Act funds have leverage limits, but futures do not count towards those limits, while repo positions do. Also, one of the ways these funds compete is by keeping interest expenses low, and repo financing counts towards interest expenses, while futures do not. Let me now turn to the benefits and risks of the basis trade. In terms of benefits of the basis trade, market participants will take different views of whether securities or futures are undervalued. The dynamic makes the basis trade appealing to various market participants and provides some potential benefits. These are greater market depth and liquidity, greater price efficiency, potentially lower funding costs for the federal government. Some of the specific risks of the basis trade are market liquidity and counterparty risks. I would also like to mention leverage. The basis between cash and futures positions is usually small, and for that reason, significant leverage is generally required to make the basis trade economically viable. The unwind of that significant amount of leverage could pose systemic risk considerations given the critical role of the Treasury market and ecosystem. That concludes my remarks. I'd like to hand it over to Team Cudahy. Thank you.
Thank you. We will now hear pre-recorded remarks from Tim Cudahy, who is not able to join us today.
Good morning. I am Tim Cudahy, Chief Risk Officer of the Depository Trust and Clearing Corporation, a member of the AMRAC, and a contributor to the best practice recommendations that the Market Structure Subcommittee is presenting today. I apologize for not being able to join today, but I appreciate the opportunity to provide some pre-recorded remarks on the Treasury cash futures basis trade. The Treasury securities, futures, and repo markets are key components of an ecosystem that support price discovery and liquidity across the financial system, both domestically and internationally. The basis trade has garnered significant attention recently with increased Treasury futures activity driven by both traditional and leveraged investors. In addition to market fundamentals and dynamics, it is important to understand the potential benefits and risks of the basis trade. This was the impetus to develop effective risk management practices for the basis trade. Managing the basis risk is crucial for market participants, particularly in periods of market stress. Financing costs, differences in liquidity between cash and futures can become more pronounced during such stressful periods. This could affect the basis spread and lead potentially to significant losses. Our recommendations focus on 4 key areas. First, market participants should continuously assess and manage the risks associated with the basis trade. Risk metrics, cash flow modeling, mark-to-market attribution, and stress scenario analysis should be used to understand and manage the specific and portfolio risks associated with Treasury cash, futures, and financing positions. Market participants should have contingency plans for unwinding leveraged exposures in an orderly manner. Second, market participants should manage market risks that could affect the performance of their portfolios. We specifically call out correlation and cheapest to deliver risk. Third, market participants should evaluate and manage their liquidity risks, including the risk that margin costs increase rapidly and significantly, and that repo or other financing is reduced or becomes unavailable. Last, market participants should appropriately monitor and manage counterparty credit risk associated with the basis trade, including effective due diligence, onboarding, having credit risk mitigants, and continuous monitoring. For each of these focus areas, we have outlined 2 to 3 recommendations that provide more granularity. In conclusion, the stability of the U.S. Treasury market, including cash, futures, and repo markets, is essential for traders, risk managers, and the official sector. The basis trade provides insights into market dynamics and facilitates risk management strategies. These practices highlight the importance of our collective role in safeguarding this market with these recommendations. Thank you for your time today.
Thank you to Tim and Alessandro. Before I turn it over to Jennifer and David, I'll mention that the conclusion of the report includes some additional considerations for the MRAC to encourage. It recommends that the MRAC encourage regulators, self-regulatory organizations, and accounting bodies to review regulatory accounting or reporting practices that may treat the use of Treasury futures differently than the use of repo financing of Treasury securities in circumstances where they would be economically similar. In addition, the report recommends improving the available data to the official sector on the size of long futures positions, basis trade positions, and associated risk management practices that could provide insights that lead to further market structure improvements. The official sector could also consider making appropriately anonymized and aggregated data available to the public. Finally, the report recommends that the basis trade and risk management practices be continually evaluated in light of changes in market structure, including Treasury central clearing rules, the growth in cross-margining, and changes in available data. Thank you very much. I'll turn it over to Jennifer and then David.
Thank you, Commissioner Johnson and Chair Crichton, for helping sponsor and arrange for the meeting today. I appreciate participating in this effort to look at, examine, and demystify the Treasury basis trade. I think all the events of March 2020 has had everyone very interested. And so I think it has been especially important for MRAC and the subcommittee to take a deeper dive, and I think we've done a very good job at examining the various participants. Markets are complex. You have a lot of different market participants and a lot of different factors. The Treasury markets have changed over the years, and I think as we've looked, as the IAWG has continued to look over the years at some of the things that have changed, and then from March 2020, Treasury basis trade was certainly front and center for everyone. And I think it's been very important, rather than to jump to conclusions, to really examine the role. We think it's very important to have a very diverse market, to have various types of market participants that engage, that provide the liquidity, which also adds to depth of market, market efficiency, and then there are a lot of benefits. And so speaking with respect to hedge funds, I think that these market participants play a really important role in contributing to market liquidity, market efficiency, and then it is an arbitrage trade that is not a new one, that banks have engaged in, different types of market participants, and we say hedge funds, but it is a broader cohort than just hedge funds engaging this. And I think it is also important as we look at some of what the speakers have said. I think that they've made some good points. It is challenging and difficult to measure leverage and risk, and so it is not an easy and straightforward exercise. A lot of different factors that go into it. At the end of the day, I think that we've done a good job highlighting the various roles of different market participants. I think it's important to consider how this market works, and rather than jump to conclusions, because I think at the end of the day, additional things that are important to consider is the market liquidity as to how it impacts government funding and as Alessandra Coco mentioned, and then also the operational efficiency for other market participants, more broadly, the other asset managers. I think this sets up for an opportunity for government going forward as we look. Because I think, again, what has brought us here is concern about the resiliency of the Treasury markets and Treasury market structure. I think this is one aspect of it. I think as we look at this and looking at what's to come, I think the next big challenge for us is looking at Treasury clearing. I think this provides a lot of benefits. We, MFA, have been supportive of additional Treasury clearing. However, at the moment, we are very concerned that there hasn't been enough time given before the mandatory clearing goes into effect in 2026. And I think one of the concerns here is that if the proper infrastructure is not built before this mandate goes into effect, we will have much bigger problems than just Treasury basis. And so I urge everyone, along with policymakers, to re-examine what we have the road ahead, because that could cause greater problems with respect to the Treasury markets functioning as they should. Thank you.
Okay. I'm David Bowman, a Senior Associate Director at the Board of Governors here in Washington, D.C. As of Alessandro, I should start by saying that my remarks reflect my own views, not necessarily those of the Federal Reserve Board. I'll be brief. I do want to commend Commissioner Johnson, the MRAC, for supporting the work by the Market Structure Subcommittee on this topic. I do think it's important. And I think that the paper is a good one. I think the focus of the paper on establishing practices, sound practices for engaging in the basis trade is potentially quite helpful to the extent that firms can establish that they are found following sound practices, including holding enough liquid resources, looking at extreme risks, understanding that others may choose to unwind at the same time that they would choose to unwind a trade. To the extent that they can establish that they are handling those risks in a safe and sound way, I think that will lead to a better discussion with the regulatory community, and help to establish that the basis trade is consistent with a resilient Treasury market. I want to talk about one of the other recommendations from the paper. So I and some of the other individual subcommittee members talked to a number of asset managers, insurance companies, pension funds about their use of futures, and the paper reflects some of the findings that we had from those conversations. As has been noted, there are many reasons that these firms use futures, including liquidity and operational ease, but across them, there were noted a variety of regulatory, accounting, or reporting practices that were set for them that incentivize use of futures in some cases over holding a cash treasury and financing it by repo, even though that might be those two positions might be completely economically similar. So Alessandro alluded to some of those. So for instance, repo would be counted as an interest expense in some reporting, but futures would not. But economically, they're the same, and there's this exact same interest cost across them. Those kinds of things can incentivize some firms, some asset managers, away from holding cash treasuries and financing them through repo, and encourage instead use of futures. I think it's important that the paper does recommend that regulatory agencies, self-regulatory organizations, and accounting bodies examine their rules and try to treat like for like. So where repo and cash treasuries are economically similar to futures, I think it would be helpful to the market's resilience overall, if the accounting regulatory rule standards treated those things in the same way. We don't need to incentivize people not to hold cash treasuries, given the importance of the market.
I want to just hop in here. It's a point of order. I apologize if there is someone following Robert's rules carefully. You'll note that I'm not the next item in the agenda. I just want to thank David personally for his service on the subcommittee. I'm grateful to every member of the MRAC and all of the subcommittees because of your willingness to volunteer your time and expertise. Or David's stepping down from the subcommittee after having served on this particular report and others earlier. And I just wanted to acknowledge and thank him for his service.
Great. Well, thank you very much to all of our speakers there. At this time, I'll open the floor to questions, comments, and discussion from the committee members.
Thank you so much. I appreciate the work of the committee. I've got a question about market participants in this Treasury market and particularly affiliate transactions. We heard from both Millennium and BlackRock, and they appear to be talking about their involvement in different aspects and perspectives in this market. The financial press is reporting that BlackRock and Millennium are in negotiations for BlackRock to take a significant minority interest in Millennium. And so I'm just wondering what impact on these markets would occur if you've got significant affiliate transactions.
I'm going to pass that along, if it's okay, to anyone from the subcommittee who may want to respond. Thanks so much, Ty, for the question.
I guess I would just jump in and say that the report doesn't really contemplate anything associated with affiliated transactions. It's really focused on the basis trade. It's a good question, though.
Great. Are there any other questions or comments? Okay. Well, we've now discussed at length the Treasury cash futures basis trade and recommendations for effective risk management practices. Is there a motion from the body to adopt this recommendation and submit the introductory paper and accompanying recommendations to the Commission?
So moved.
Is there a second?
I second.
Thank you. It has been moved and seconded. Are there any additional questions or comments? Okay. Seeing none, committee members, are you ready to vote? Yes, great. The motion on the floor is for the committee to adopt the introductory report and subcommittee recommendations on the Treasury cash futures basis trade and effective risk management practices, and to submit the amended report and recommendations to the Commission for consideration. As a reminder, abstentions are not counted as a vote, and as a point of order, a simple majority vote is necessary for the motion to pass. I will now turn it over to Danielle, DFO, to conduct a roll call vote.
Thank you, Chair Crichton. Committee members, when I call your name, please indicate your agreement with A, disagreement with nay, or indicate abstain if you are abstaining from the vote. We will start with the in-person attendees, and then we will move to the virtual attendees. If you are on video, please remember to turn on your camera and your microphone when speaking, and then to turn both of them off when you are done voting. With that, we will get started. Alicia Crichton?
Yes.
Robert Allen?
Yes.
James Andrus?
Yes.
Ann Battle?
Yes.
Stephen Berger?
Yes.
Dick Berner?
Yes.
Alessandro Coco?
I'm not a voting member of the committee.
Excuse
Thank
me. Graham Harper?
Yes.
Lindsay Hopkins?
Yes.
Annette Hunter?
Yes.
Dimitri Kourousos,
Yes.
Ernie Conkey,
Yes.
Andrew Nash,
Yes.
Jessica Renier,
Yes.
Tyson Slocum.
Abstain.
Now we will turn to our virtual attendees. Edward Dasso,
Yes.
David Horner,
Yes.
Eileen Keeley,
Yes.
Derek Kleinbauer,
Yes.
Chip Lowry,
Yes.
Craig Messenger,
Yes.
Marnie Rosenberg, she had to step away for a minute, Suzanne Sprague,
Yes.
Biz Chatterjee,
Yes.
Elizabeth Kirby,
Yes.
Dmitry Snenko,
Yes.
thank you, Kristen Smith, not present. Okay, are there any members of the committee on the line that I might have missed? Okay. Chair Crichton, you have 23 yes votes and 1 abstention and 0 no votes.
Thank you very much. The ayes have it, and the motion carries. The introductory report on the Treasury cash futures basis trade and subcommittee recommendations on effective risk management practices have been adopted by the committee and will be submitted to the Commission for consideration. Our next presentation today comes from the Technology and Operations Workstream of the CCP Risk and Governance Subcommittee. First, we'll hear perspectives on cyber resilience from the following speakers: Sanjeev Bhaskar, Deputy General Counsel, Office of the National Cyber Director; Todd Conklin, Chief Artificial Intelligence Officer and Deputy Assistant Secretary of Cyber, U.S. Department of the Treasury; Steve Pugh, Chief Information Security Officer, Intercontinental Exchange; and Don Byron, Head of Global Industry Operations and Execution, Futures Industry Association. We'll then turn to a discussion of the recommendations on DCO system safeguard standards for third-party service providers from the following subcommittee members: Alessandra Coco, Senior Policy Advisor, Federal Reserve Bank of Chicago, on detail at the U.S. Department of the Treasury; Dr. Dick Berner, Clinical Professor of Management Practice in the Department of Finance and co-director of the Stern Volatility and Risk Institute, New York University; Juan Blackwell, Director, Risk, Head of Credit and Counterparty Risk Management, Ontario Teachers Pension Plan. Following these remarks, we'll have open discussion from MRAC members. I'll now turn it to Sanjeev, Todd, Steve, and Don.
Thank you to Commissioner Johnson, Chair Creighton, the CFTC, and the MRAC for inviting us. It's an honor to be here on behalf of the Office of the National Cyber Director at the White House. In our brief remarks, we'd like to talk a little bit about what we are seeing at the White House and the role the Office of the National Cyber Director has played when it amounts to cyber resilience. Specifically, our office advises the President on cybersecurity policy and strategy, including cyber resilience. We've done this in a multitude of ways, partnering with members such as those here in the audience today through one, the National Cybersecurity Strategy, which provides 5 pillars that discuss, among other things, cyber resilience and how to go about through 27 strategic objectives achieving this. I'll pull 2 points from this to share with you in our brief remarks today. One, that we must rebalance responsibility to defend cyberspace and endorse cyber resilience by shifting the burden for cybersecurity away from individuals, small businesses, and local governments, as well as infrastructure operators, and onto organizations that are most capable to assume and reduce this risk. And two, we must realign incentives to favor long-term investments with these institutions by striking a balance between defending ourselves against urgent threats today and at the same time planning for investing in a resilient future. Now, with saying that, through this strategy, we've endorsed implementing a plan that supports our national cyber security as well as cyber resilience. And while that is ongoing, specifically in the realm of cyber resiliency, I highlight 5 points. And from a bigger perspective, our decisions and our dialogue has been, if we are to achieve cyber resilience, we need to have vision as to what's taking place in the marketplace, in society writ large. Two, we need to have a dialogue, which we are having today, among various partners in government, private sector, financial industry, healthcare, again, to understand the challenges we're facing and to learn from them to demonstrate resiliency. And then finally, engagement. And by doing this, having vision, dialogue, and engagement, our goal is to be prepared. Prepared for threats, prepared to survive threats, prepared to thrive as we approach 2025 in these areas. Now, within the cyber resilience umbrella, 5 other subpoints I'll mention very briefly. One is being better prepared. It is our position that through planning exercises, having sufficient policies in place, both in government and private sector, we are visionaries and better suited to take on risks and challenges that will eventually come forth in the cyber realm. 2, the importance of hardening and preparing our systems, our cybersecurity systems, making sure we're utilizing multi-factor authentication, having backups and patching in place, and being cognizant of end-of-life challenges. When we have software that at certain points will no longer have updates provided by the manufacturer, are we prepared to address this? Additionally, let us pivot to blockchain technology and post-quantum computing. When we have encrypted technology that can be defeated by these post-quantum computers, are we prepared for that, and how do we engage in those regards? So hardening our systems is a big part of the vision when it comes to cyber resilience. Additionally, an encouragement for stronger software, whether it be secure by design, where our software products and capabilities are designed to be foundationally secure, or secure by default, where the technology, the software is secure out of the box without need for additional security configuration. And a benefit that provides to society, specifically individuals that may not be technologically conversant. Instead of relying on an upgrade that your parents or family members must do on their phone or software, how about out of the box, secure by default, the technology will be secure. So that's another discussion that we're having, and we encourage when it amounts to cyber resiliency. 2 more brief points. Partnerships with the private sector, with government, involving reporting, intel sharing, discussing emerging technologies. We like to joke at times that some of this, or I shouldn't say joke, but say with some hubris, some of the technology did not exist many, many years ago. And as we learn, as we move forth here, it's important that we're discussing how the technology works, whether it be blockchain technology, cryptocurrency, artificial intelligence, software issues I mentioned already, to have this discussion with those that are in the room creating this, and again, sharing techniques that can better harden our systems, as well as intel sharing when we see threats, the importance of a public-private partnership. And then finally, and something I underscored today from the administration, is the importance of people. Having a good cyber workforce, training, the ability to engage and learn together and further develop the knowledge and skill set when it amounts to cybersecurity within the United States. This is a collaborative effort. We are learning together, and we are excited about the progress we can make in these areas in 2025. Thank you for inviting us.
Thank you, Commissioner Johnson, for hosting us. It's an honor to be here. speaking from the private sector perspective, I just want to say, we're in an era of increasing reliance on third-party vendors to perform critical business functions in this modern supply chain. And the interconnectedness of both private industry, government, and technology necessitates a structured approach. And this is only possible through understanding and transparency and communicating with vendors. On the topic of identifying risks and vulnerabilities, this generally happens through the diligence phase for us. And so we like to be in communication and go through a robust diligence, ensuring transparency and understanding what standards must be met so that we can properly position ourselves to reduce risk before we step forward into any agreements. Next, we follow up through contractual communications, negotiations, and expectations. Now, part of that is within communication, but part of it is technology standards. Things such as backup testing, fallback arrangements, and even escalation of communication protocols should something happen. Audits and compliance rights are equally important, but not necessarily specific to one individual customer. And so if an audit or a test can be done by the vendor, by a reputable third party, that can satisfy some of the requirements. So the point being that you don't add an increased burden for every customer to go in and audit and run through compliance regimes. Ongoing monitoring and communication, I think, is also pivotal. It's not just a one-time due diligence check on vendors. This is a very dynamic environment, and so the ability to continue to maintain communication, understand things that are changing through regular reviews, even early warning indicators, the public-private partnerships and intel sharing groups, those are all critically important to maintain the highest levels of resilience. Routine checkups and quarterly business reviews also help within that, and then also immediate incident reporting lines. Now again, perfect world, nothing happens, but oftentimes there are events, and so to be prepared, I think it's also important that we structure at least tabletop exercises or thinking through how an incident would unfold. We've had a little bit of experience with that lately, but I think one of the really nice things about the public-private partnerships and trade groups is they're able to bring together a collective, given that this is a team sport, to really test out what would happen and think through some of these extreme but plausible scenarios. And then lastly, again, given how dynamic this environment is, there's always something to learn and something to get better with. And so we don't view this as just a process to go from A to Z and be done, but rather a continuous cycle that we repeat over and over again. Again, limited by constraints, and as Jeev mentioned, people is important, and so limited capacity. So we take a risk-based approach, and for our highest tiered vendors, we tend to be a little bit more scrutinizing over them. I'd conclude in just saying that we're in a very connected ecosystem, and that's a good thing. There's a lot of advantages that provides, but we need to manage those relationships through a proactive and structured approach. Like I mentioned, identifying risks, setting clear expectations, collaborating on recovery, and learning from those incidents. And building resilience is an ongoing effort that ultimately protects the operations and critical things that we're doing across the nation. Thank you.
Okay, thank you, Commissioner Johnson, for the invite here. My name is Todd Conklin. I'm Chief AI Officer for the Department of Treasury. I'm also our Deputy Assistant Secretary for the Office of Cybersecurity and Critical Infrastructure Protection, which for everyone's general awareness, that's the office within Treasury that's responsible for the Sector Risk Management Agency function of the department, which is ensuring the healthy cyber function of the broader financial sector. And we administer that in complete lockstep with the federal financial regulatory bodies through a vehicle that I chair called the FIBIC. And then also we have an ability to reach into financial sectors and trade groups via what we call the FISIC, the Financial Services Sector Coordinating Council, where we could formally work on public-private partnership issues. And as Steve Pugh laid out really well, the model that we've been using to administer our sector risk management function has been to work with the federal regulatory agencies and the financial sector through those vehicles to identify emerging risk issues, publicly identify them in a report,
detail a series of risks that we all collectively view, and then work collectively on a series of next steps to try to close the gaps that we identify collectively in those reports. So about 2 years ago, we released a report on cloud, and followed that report with 9 total work streams that we worked in tandem with the federal regulatory agencies and also the financial sector to really strengthen the cloud ecosystem and try to promote more of a secure by design model from the cloud providers. And we've had some pretty significant success stories out of that effort. Earlier this year, we also pivoted to focusing on artificial intelligence, and I think I do have a slide deck. I don't know if we want to show it, otherwise I could talk highly. So following that same model, Treasury convened in-depth interviews with federal financial regulatory agencies earlier this year, and more than 50 financial institutions, ranging from our largest financial institutions to our smallest local and community banks, to really get of understanding and mosaic of where the financial services sector is in terms of AI adoption and what their future plans are and any risk issues that they've been able to identify. I don't know if we have the slide deck. If it's not ready, I can talk through it.
We were planning to do it for the later remarks on AI, but we can pull the slide.
Oh,
now.
apologies. Am I going to? Should I keep going for the?
You're so nice. We invited you twice.
Oh, apologies. Oh, okay. My apologies. So anyway, I won't do the full slideshow, but a long story short is that the biggest threat area, and Steve laid this out well, in the cybersecurity landscape, it's very much a team sport. So on a daily basis, the Treasury team is interacting with not just the regulators, but Steve's team as an example, and participants across the sector to share intel information, and we also flow that in automated ways now for the first time directly into firms' protective DNS environments, in addition to providing tools like cyber hygiene scanning for our smallest institutions. So part of our tactical pivot has been to really try to reach in as much as possible to provide free tools to firms to automate the flow and protective options across the sector. And it's been a really successful program that especially the small banks, local community banks, have benefited greatly from. And part of our methodology is how do we scale the expertise of the largest institutions to the smallest institutions, since they're so interconnected that the weakest link really has the potential to disrupt the healthy function of our financial sector operations. So hyper-focusing on supporting the smaller institutions by leveraging the collective ecosystem. That same team mindset that we have in cyber, unfortunately, does not exist in the fraud landscape, which historically has been a bit more siloed within the financial sector, and that more of a methodology of we just have to be stronger than the next bank to protect our own kind of fraud operations. And that mindset, which I'll go into later, with the overlay of AI tools and the necessity of vast quantities of data, which just isn't available to smaller banks, does have the potential to cause some disruptions within the financial sector landscape, which I'll go into greater detail. But thank you so much, Commissioner Johnson. Looking forward to speaking again later.
Hi, thank you. My name is Don Byron. Thank you to Commissioner Johnson and MRAC for having me on and the opportunity to update the work that FIA has been doing over the last year and a half or since March 2020. Just as a recap, there are some slides up there. Thank you. In March 2023, we had a cyber attack that impacted a single provider in our industry. In response, we announced the formation of a task force, which consisted of BARC participants from across the industry. In September 2023, the task force released an after-action report with several recommendations for improving the industry's ability to withstand the disruptive impacts of a cyber attack or an outage. In December of this past year, 2023, we took one of the first recommendations was to form what we called the Industry Resilience Committee, or IRC, which was recommended by the task force. Our IRC, it acts as a trusted forum for key stakeholders to discuss cyber incident management, resilience planning, and recommended best practices for the industry. The next slide, please. The Industry Resilience Committee is made up of a cross-section of SMEs from across our industry. So that includes not only information security experts, that includes folks from application technology, from operations, and other areas as well. And the idea is to build up trust amongst the different folks who would be responding or key stakeholders in the event of an incident. A few of the priorities I just wanted to cover on for this update. One is one of the priorities is incident response. So as I mentioned, serving as a trusted group for sharing information and coordinating response. We learned in the January 2023 incident just how important that was to be able to have a forum for people to get information and share information, et cetera. And that includes not only cyber event, as we've learned since then, but also any other type of outage, specifically the CrowdStrike incident from over the summer, and others where we've been able to act and serve as for that forum as well. We've heard it mentioned already, sector engagement. One of the goals is to engage with the financial sector, including the FISC, the Financial Services Coordinating Council, which Todd mentioned. We also work with CMORG in the UK and partner with other associations such as SIFMA, who we work with them, and they're also part of our Industry Resilience Committee. And the last priority really was to focus on what we called in our report, our task force report, the 3 Rs, which is the response, which is coping with the immediate impact of a breach, recovery, which is rebuilding and restoring systems, and then reconnection, which is reconnecting to market infrastructure. On that last piece, on the reconnection, we are engaged with some of the sector work that is going on to review those reconnection guidelines, and again, passing along our lessons learned from our incident. Next slide, please. Thank you. And one thing I want to do, lastly, what I wanted to do was preview here today something that we've been working on for the last several months, and we think it's going to be very important for our industry and our market participants. So our Industry Resilience Committee has been working on what we're calling a CCP incident response and data questionnaire. This questionnaire has been worked on by all different market participants, including exchanges, CCPs, clearing members, vendors as well. So the whole industry, all members of the Industry Resilience Committee coming together. And the focus of this is to aim at assisting members in recovering clearing, settlement, reference, and risk data during an incident or an outage. Particularly a multi-day outage. One of the lessons learned we found was trying to identify and have all the information available was challenging at times. So the idea here is to have this questionnaire, have it be available, have all market participants understand what's happening ahead of time, and considering the role and the importance of exchanges and CCPs in our industry, we figured that would be the good place to start. I won't go through all these in too many details, but the 4 main areas that are of the questionnaire will be the incident response plans and notifications, which is simply clarity around what are some of the high-level plans that exchanges and CCPs will have during an incident, and when will they make those available. Access to clearing data, records and data, so things like clearing and trade records, settlement prices, risk data, reference data. What type of data will it be available? Third, data format. Will the data be available in a format that is similar to what it is in production, or will it be in a different format? When will it be, what systems will be available? Will there be backups, et cetera? And then lastly, data retention and availability of historical data, such as will data be intraday, end of day, will there be historic data, et cetera? And the big reason for these particular items is that one of the lessons learned we found is that even if you are ready to reconnect, if your systems are not back up and running and are not up to date, that process can be delayed. So the idea here is having transparency on when exchanges and what data will be made available will help in future incident responses. And then lastly, the responses, the intent of this is to have those, to provide these questionnaire once it's completed, in early 2025, to exchanges and CCP so they can provide these answers directly to their clearing members and ISVs, third parties as well. So thank you.
Thank you. Commissioner Johnson, Chair Crichton, staff, thank you for having me here today. I would like to introduce the report of the Technology and Operations Subcommittee of the MRAC on DCO system safeguards standards for third-party service providers. As I mentioned earlier, the views expressed here are my own and not those of the U.S. Treasury or the Federal Reserve System. Clearinghouses, like other market participants, are increasingly relying on third-party service providers, as we've heard today. In some cases, third-party providers perform core functions for the DCO. The purpose of the report I am presenting today is to set out some recommendations from the Technology and Operations Subcommittee for the Commission to take into account when considering the safeguard standards applied by DCOs to third-party service providers. The main area of focus of the recommendations is to require DCOs to introduce a third-party relationship management program that would comply with certain widely accepted best practices and would apply primarily to critical third-party service providers, while maintaining a principles-based approach to regulation. The recommendations are intended to be consistent with national and international regulatory standards, as well as with the lessons learned from industry-led exercises in this area, some of which we heard about today. The NFA issued an interpretive notice requiring its members who outsource certain functions to a third-party service provider to adopt a written supervisory framework. There is a well-established body of work, both internationally and nationally, that addresses the topics of third-party service providers. To mention a few, these include the Interagency Guidance on Third-Party Relationships, the Federal Reserve Board's Regulation HH, the SEC's Reg SCI, the EU's Digital Operational Resilience Act, DORA, the FSB's Enhancing Third-Party Risk Management and Oversight Report. The PFMIs also address in their Annex F a set of oversight expectations applicable to critical third-party providers. So now turning to the CFTC, Part 39 covers system safeguards, and Rule 3918 currently imposes requirements with respect to outsourcing, but does not require expressly that DCOs implement a third-party relationship program. Rule 3818D2 provides that a DCO that enters into a contractual outsourcing arrangement retains responsibility for any failure by the service provider to meet the requirements specified in the CFTC regulations, in particular with respect to risk analysis and oversight, business continuity, and disaster recovery. The DCO must employ personnel with the expertise necessary to enable it to supervise the service provider's delivery of the services. And in addition, a DCO must conduct regular, periodic, and objective testing of the outsourced resources, as well as of its own resources. In addition to the requirements set out in the CFTC's rules, the Commission's Form DCO requires the DCO to provide information to the Commission with respect to outsourced resources. In the instructions to Form DCO, Commission staff require an applicant who intends to use the services of an outside third-party service provider to identify the services that will be provided, the staff of the third-party provider who will provide the services, and the core principles addressed by the arrangement with the third party. Form DCO also requires the DCO to provide the outsourcing contracts. So finally, turning to the recommendations in the report, the subcommittee recommends that the Commission maintain a principles-based approach and build upon the principles already set out in the System Safeguards Rule that are found in Part 39. And it would add, however, third-party relationship management program principles to the current wording of Part 39. These principles are intended to reflect lessons learned from industry efforts and best practices in derivatives. The guidance notes in Form DCO, the NFA interpretive guidance, lessons learned from the wider context of third-party relationship management, as well as the principles enunciated in the PFMIs. Incorporating these principles in Commission regulations would enable the Commission to keep its regulatory framework updated with respect to critical third-party service providers and to bring it in line with internationally accepted standards. So what are some of the key characteristics of a robust third-party relationship management program? In the view of the subcommittee, a robust third-party program should identify, assess, mitigate, and monitor the full scope of risks resulting from the use of third-party arrangements. And a DCO should conduct a pre-selection and an onboarding due diligence assessment before entering into any third-party service arrangement of the impact of the DCO's operational risk. A DCO should also establish written policies and procedures to determine which of the DCO's third-party service providers are critical third-party service providers. And what are the key criteria for determining if a third-party service provider is critical? These are the potential to have a material impact on CFTC-regulated activities, an impact to critical operations or viability, material impact on the ability to meet key legal and regulatory obligations, significant customer impact, potential significant security risks, including cybersecurity, and the risk of concentration of third-party providers that the DCO has an arrangement with. With respect to critical third-party service providers, a DCO would be required to apply enhanced risk-based due diligence and oversight. This concludes my remarks, and I hand it over now to Professor Dick Berner.
Thanks, Alessandro, and thank you, Commissioner Johnson and Chair Crichton, for having me speak today. My remarks will be very brief, given the comprehensive nature of the comments already made so far. I just want to emphasize that we are recommending something that brings our regulation in line with internationally accepted standards. There's been a lot of discussion here today about all this diligence is really a team sport. Steve mentioned that, Todd mentioned that, and I think that extends to our global counterparties as well, because they're facing many of the same problems, and the financial system is interconnected, not just within borders, but across borders. And I think this recommendation gives the Commission the flexibility to engage with those, with a principles-based approach, notwithstanding the differences across jurisdictions and legal arrangements. Thank you.
Thank you, Commissioner Johnson. Thank you, Chair Crichton, Alessandro, and Dick for allowing me to come here today and speak on this matter. One of the key things that Ontario Teachers does when we look at which DCOs we will trade more than a few derivatives on is whether or not that DCO actually retains responsibility for third-party selection. This is key to us. It's near and dear to our heart. If I happen to choose to sell wheat forward for delivery, and I fail to maintain the truck that I've chosen to deliver said wheat, I don't get to call up the CME and say, sorry, I didn't maintain my truck. You're not getting your delivery. All of this technology, as we send those zeros and ones back and forth across the trading day, is that truck at this point in time, which is why, in my view, this is so important for the CFTC. Thank you.
Thank you very much, and thanks to both sets of panelists for their comments. I'll now open it up to a discussion from the MRAC members before we move further into votes. Are there any questions, comments? Jessica?
Yeah, thanks. I just have a question or a clarification. I think brought up both by Todd, some of your comments around fraud and the connection of fraud to cyber, and then getting to other Treasury views, perhaps. I just want to make sure that in the discussion about bringing in and how we address critical third parties, that we are clear that we are not conflating issues of fraud with issues of cyber resilience in these recommendations, because they are not the same thing, and sometimes are often discussed in the same venue simply because fraud is now occurring in an increasingly just digital format simply because we operate on computers every day. And I'm conscious not to suggest that any financial institutions or infrastructures associated with that are necessarily responsible for fraud that occurs on a third party activity that then is presented to the institution or the infrastructure as being legitimate, and that it somehow becomes that institution's fault. And I think that that's a point of discussion broadly also being discussed in the international community in Basel groups, what the appropriate reaction to that is. So I would separate those two issues, and I just want to make sure that the comments by Treasury doesn't intend to conflate those two issues in this recommendation.
No, and I think you're hitting at the spirit of, frankly, the fundamental issue we have with fraud is that it's not squarely in any one U.S. government agency's jurisdiction, and then there's a gap in coverage across the trade groups, right? And that gap has really caused us to be a little flat-footed over the last several decades in our response as these cyber-enabled tools and AI tools are being leveraged by the adversaries, right? We haven't quite found our sweet spot of how we do the public-private partnership on fraud. So that's issue one. Issue two, where it is a third-party issue, is what we framed in the Treasury report and the framing of my comments. It's around the data gap. So if you're a larger institution, in many cases, they have, in one case in particular, they have hundreds of their own AI developers working specifically on fraud and cyber with predominantly their own data, in-house data. Contrast that with our smallest institutions. That was my point, that the smaller institutions don't even generate enough of their own data to do their own fraud modeling. So that means that they have a third-party requirement to bring in data. And that's where the body of work that we're going to focus on around nutrition labeling, which I'll get into, like we have to help our smallest institutions, if they do have this external data requirement, that either leads them down a third-party vendor, or the U.S. government needs to support them, or other financial sector firms need to support them, right? And that's the third-party gap that we have in the fraud space.
And I just wanted to add that the report we're presenting today is not a recommendation from the U.S. Treasury, it's a recommendation from the subcommittee. And there is no specific focus on fraud, but I wouldn't infer from that the report necessarily conflates fraud with cybersecurity. So I just wanted to clarify that.
Great. I believe we have one of our virtual joiners, Marnie Rosenberg. I think she had a comment.
Thanks, Alicia. Yep. So I just wanted to express JP Morgan's support for this recommendation and this paper. We support the application of third-party risk management expectations for derivatives clearing organizations. Effective TPRM is essential to safeguarding against potential risks and vulnerabilities within third-party ecosystems that could lead to operational disruption. Moreover, as the financial system grows more interconnected and relying on third-party service providers, the importance of maintaining robust TPRM is increasingly being recognized as a key driver of resilience and financial stability. JP Morgan fully supports the MRAC's proposal to integrate TPRM expectations into the regulatory framework for DCOs. A regulatory framework for an effective TPRM program will enable DCOs to identify, assess, and mitigate risks arising from third-party service providers across the life cycle of a third-party arrangement and maintain the continuity of their critical operations. The proposed recommendations, as currently drafted, do not, though, fully reflect some foundational TPRM principles outlined in the FSB's third-party risk management toolkit, including, for example, how the application of a risk-based approach enables the entity to tailor the optimal controls, due diligence, and oversight to the specific risks presented by each arrangement. We would therefore strongly encourage the Commission to ensure that any proposed TPRM obligations for DCOs align with established international standards and best practices, including the FSB's 2023 Third-Party Risk Management Toolkit. Such standards reflect widely recognized TPRM principles, which emphasize proportionate, flexible, and risk-based approaches. Importantly, they also address specific considerations for critical third-party arrangements, ensuring that these arrangements are subject to the most heightened levels of risk management. Additionally, we would encourage alignment with CFTC's proposed guidance on operational resilience and third-party risk management for swap dealers, FCMs, and major swap participants, along with considerable feedback received from industry stakeholders. Thank you.
Thanks, Marnie. Tyson.
Thank you. I really applaud the work of the subcommittee on this, so thank you very much. I just had a clarifying question about whether or not disclosure of the identities of third-party service providers are provided to the CFTC or not, either under current policies are under this proposal?
So thanks so much for the question, Ty. I'll hop in here and draw from a thread offered in Marnie's comments as the very last speaker, and also clarify for everybody in the room a few things. In the first instance, Marnie mentioned a proposed rule that is awaiting finalization and publication as a final rule on operational resilience in the context of swap dealers. So thanks, Marnie, for referencing that. It certainly was an inspiration, I think, to the subcommittee for taking up this matter. I mentioned in the open meeting where we discussed that proposed rule that this very work stream would be an ideal direction of travel. Lee Betzel at CME had even previously introduced the same concept, and I think he and Chris Edmonds as co-leads for our technology and operational work stream had focused on these questions. That proposed rule, the commission has not yet finalized, as I mentioned previously, and to date, I'm aware that the Division of Clearing and Risk is thoughtful about a parallel set of enhanced or modernized cyber regulations and critical third-party service provider regulations, but I would be speaking out of turn to share something that has not yet been formally introduced by that division or by the commission in the form of a proposed rule. But I take note of what you've shared, and I think we would certainly like to include that comment as well as Marnie's comment and Jessica's in the context of our advancing this set of recommendations. And our hope is that the commission will be thoughtful about all that we're sharing and begin to take up in earnest proposed rulemaking in this direction. So I hope that's helpful.
Okay, ahead of moving to a vote, are there any further questions or comments on these recommendations on DCO system safeguard standards for third-party service providers? Okay. Seeing nothing further, we've now discussed at length these recommendations. Is there a motion from the body to adopt this recommendation and submit the recommendation to the commission?
Yes, Chair Crichton. I move that the committee adopt the subcommittee's recommendations on DCO system safeguards, standards for third-party service providers. My question would be whether or not we include the comments that were just made by Tyson and Marnie.
Thanks for that point of information, Dr. Berner. I think what I'd highlight is at the outset, we could have said, and we often do say in the formal rulemaking meetings, that any amendments that are improvements to and not objected to by the committee will be noted in the committee's advance of the specific standards and recommendations that are presented to the commission. So any conforming and corrective changes we can integrate into the report and distribute the same. Thanks so much.
So noted. And also move that the committee submit the recommendations to the commission for consideration.
Thank you. Is there a second?
Second.
Great, thank you. It has been moved and seconded. Are there any additional questions or comments? Okay, seeing none, committee members will now move to a vote. The motion on the floor is for the committee to adopt the subcommittee recommendations on DCO system safeguard standards for third-party service providers and to submit those recommendations to the commission for consideration. As a reminder, abstentions are not counted as a vote, and as a point of order, a simple majority vote is necessary for the motion to pass. I'll turn it over to Danielle to conduct a roll call vote.
Thank you, Chair Crichton. Committee members, when I call your name, please indicate your agreement with A, disagreement with nay, or indicate abstain if you're abstaining from the vote. Once again, we'll start with committee members in the room and then move on to committee members joining us virtually. Please remember to unmute your audio, and if you are virtual, turn on your video to indicate your vote, and then to mute your audio and turn off your video once we have finished voting. Alicia Crichton.
Yes.
Robert Allen.
Yes.
James Andrus.
Yes.
Ann Battle.
Yes.
Stephen Berger.
Yay.
Dick Berner.
Yes.
Graham Harper.
Yes.
Lindsay Hopkins.
Yes.
Annette Hunter,
Yes.
Dimitri Karosos,
Yes.
Ernie Conking,
Yes.
Andrew Nash,
Yes.
Jessica Renier,
Yes.
Tyson Slocum.
Yes.
Thank you. We'll now move on to our virtual attendees. Edward Dasso,
Yes.
David Horner,
Abstain.
Eileen Keeley,
Yes.
Derek Kleinbauer,
Yes.
Chip Lowry,
Yes.
Craig Messenger,
Yes.
Marnie Rosenberg,
Yes.
Suzanne Sprague,
Yes.
Biz Chatterjee,
Yes.
Elizabeth Kirby,
Yes.
Dmitry Senko,
Yes.
and I will pause for a few folks that have been on and off just to see if they're here for the final vote. Purvi Maniar, Andrew Park, Kristen Smith. Any other committee members on the line that I may have missed? Thank you. Chair Crichton, you have 24 yes votes, 0 no votes, and 1 abstention.
Thank you. The ayes have it, and the motion carries. The subcommittee recommendations on DCO system safeguard standards for third-party service providers have been adopted by the committee and will be submitted to the commission for consideration. Thank you. Next, the CCP Risk and Governance Subcommittee will present its recommendations on legal entity identifiers at the beneficial account holder level. Dr. Dick Berner, Clinical Professor of Management Practice in the Department of Finance and co-director of the Stern Volatility and Risk Institute, New York University, will first present recommendations from the workstream. And then next we'll hear from John Bottega, President, EDM Council. Dr. Berner?
Thank you, Chair Crichton and Commissioner Johnson. I'm pleased to discuss our subcommittee's recommendations on data standards today. A brief bit of history, just to provide context. The global financial crisis exposed significant vulnerabilities in the U.S. and global financial systems, as everybody here knows. Among them was the lack of fit-for-purpose financial data. Issuers, investors, and risk managers were unable to determine who was exposed to whom. Lacking good information, many other vulnerabilities were hard to spot. Global reform programs focused on ways to improve the scope, quality, and accessibility of financial data. A key aspect of data quality is standardization. That's essential for identifying parties to financial transactions and for comparing and aggregating information. The Legal Entity Identifier, or LEI, is such a standard. In 2011, as my former colleague, Mr. Bottega, sitting to my right, will mention, the U.S. Office of Financial Research led the launch of the LEI. In 2012, the FSB published and the G20 endorsed recommendations for a global legal entity identifier for financial markets. Today, there are 2.8 million LEIs in use, and the list is growing. Had the LEI system been in place in 2008, we would have better been able to trace Lehman's exposures and those of its subsidiaries, as well as those of other financial intermediaries. The LEI system helps answer who owns who, with LEIs for parent entities, plus an LEI for each legal entity and firms. The LEI system also generates efficiencies for financial companies in internal reporting, risk management, and in data management, eventually eliminating overlap and duplication. It provides transparency and legal clarity and certainty about the rights and obligations of a legal entity. That's why the industry has called for government regulators to mandate its use. Like any network, the LEI system has benefits that will grow as the system grows. but ubiquity is needed to realize the full benefits of the LEI. That's why the CFTC mandated the use of an LEI and daily reporting requirement on derivatives clearing organizations, or DCOs. Information related to all positions other than fully collateralized positions in accordance with specified data fields, on initial margin requirements and initial margin on deposit for each clearing member, by house origin and by each customer origin, and by each individual customer account. Second, the DCO shall identify each individual customer account using both a legal entity identifier where available and any internally generated identifier within each customer origin for each clearing member. The where available phrase appears to intend that if the LEI is not voluntarily provided to the DCO by the customer, the DCO is not mandated to require the beneficial account owner to provide one. As a result, in some cases, DCOs can identify the ultimate legal entity that is the beneficial owner of rights or obligations in regulated financial products cleared by the DCO. This legal uncertainty can amplify operational challenges. The ION cyber incident early last year highlighted the benefits of using LEIs at the beneficial account owner level and the resulting need to explore mandating DCOs to report the LEI at the beneficial account ownership in daily reporting. Now, cost concerns were a factor in where available wording, but the costs of registering and renewing an LEI are relatively low. For example, currently the cost of an LEI registration and renewal for 5 years is only 380 euros. To be sure, for entities not currently using an LEI, the costs of reconfiguring systems to accommodate the identifier also need to be taken into account. But many jurisdictions now globally require the use of LEIs, suggesting that such costs have already been incurred. CFTC regulations already set forth the requirement that swap entities and swap counterparties register for an LEI, including at the beneficial owner level. Workstream participants believe it is appropriate to introduce a similar requirement on DCOs and future commission merchants to require an LEI for beneficial account owners. The Tech Ops Subcommittee of the MRAC proposed mandating the use of the LEI at the beneficial account owner level at the December meeting last year. The proposal was well received and there were no objections from MRAC. The subcommittee now submits the proposal formally to the MRAC for approval. Specifically, the subcommittee recommends that CFTC Part 39 should be amended to bring the U.S. regulatory structure in line with global standards by mandating the use of the LEI or equivalent identifiers by the beneficial account owner level, obtained and maintained by the beneficial account owner for daily reporting by DCOs. The subcommittee further recommends that, to the extent not already required, DCOs and future commission merchants should also require that a beneficial account owner always provide an LEI with respect to any activity subject to such registered entities reporting obligation to the CFTC. One possible way for CFTC staff to implement this regulation is to delete the wording where available in Part 39. The subcommittee also recommends that the Commission host a roundtable to discuss implementation of the rule, the impact on any related rules that may be affected, and to leverage lessons learned from implementation of similar requirements. Thank you.
That's great. Thank you very much. We'll now open the floor to MRAC members for discussion. Oh, I'm sorry, John. I apologize.
There we go. Thank you. First, allow me to thank the CFTC Market Risk Advisory Committee, Commissioner Johnson, and Chair Crichton for the opportunity to speak to you today pertaining to the MRAC's proposal to mandate or extend or modify the use of the LEI. There's an expression coined by the U.S. military called bluff, bottom line up front. So given the limited time this morning, I'm going to provide you with my bottom line up front. The LEI is a critical and mandatory component in successfully analyzing systemic risk. I have a personal and somewhat emotional connection to the LEI. I had the honor of co-authoring the paper that proposed the creation of the LEI, known as the Linchpin Paper, published back in 2010 during my tenure as Chief Data Officer for the Federal Reserve Bank in New York
in my concurrent role as Head of Data Management for the Office of Financial Research at the U.S. Treasury. We were in the throes of the financial crisis. When Lehman declared bankruptcy, I was working for Citibank at the time as the bank's first chief data officer. On that fateful weekend, those of us remember being called into the office with the immediate task of determining our exposure to Lehman. But Lehman wasn't Lehman. Lehman was hundreds of Lehmans, entities and sub-entities with different local identifiers and varying legal obligations. Now, although we were able to do some internal exposure assessment without the existence and application of an industry-standard legal identifier, aggregating system-wide positions were nearly impossible. And understanding the interdependencies of the contracts were even worse, especially when multiple counterparties were involved. The basic premise of the linchpin paper was the recommendation that all legal entities participating in financial transactions should be uniquely identified. By enabling a network of interconnected legal nodes, the industry would be able to identify transactions associated with specific entities, know the legal obligations between entities, and be able to perform aggregations to rapidly determine risk concentrations, a mandatory requirement, especially in times of crisis. Now, as my colleague, Professor Burnham mentioned, nearly 2.8 million LEIs have been issued globally, and it is a requirement in financial reporting around the world. For example, under MiFID II, the use of the LEI is mandatory for transaction reporting. This requirement is part of the no LEI, no trade rule, which means that investment firms must know their client's LEI before entering a trade. This rule applies to all EU corporate counterparties and ensures transparency and accurate reporting in financial transactions. Without the correct LEI, the trade cannot be executed. Now, the LEI is one of a number of important data standards that are needed for efficient regulatory reporting. The recent passage of the Financial Data Transparency Act proposes the adoption of information standards, and I quote, to make the information reported to financial regulatory agencies electronically searchable, to further enable the development of regulatory technologies and artificial intelligence applications, to put the United States on a path towards building a comprehensive standard business reporting program. Again, as mentioned, adherence to standards are fundamental to improving data quality and consistency. They minimize misinterpretations, reduce errors, and improve efficiency. They enable the harmonization of data coming from different sources, which dramatically improves the ability to those receiving this data to perform more accurate, timely, and trusted analytics, and to leverage with confidence the latest advances in machine learning and artificial intelligence. It's an old adage, garbage in, garbage out, and AI is only as good as the data we feed it. But there's one more point I'd like to make. Achieving this efficiency through adoption of information standards, such as the LEI, can only be enabled through the application of data management best practices. Now, data management has significantly improved and matured since the financial crisis. Data strategy, business and information architecture, data quality, data governance, and technology must all work together to effectively manage the information asset. Evidence of the importance of data management already exists in the public sector. In June of this year, a report by the SEC entitled Semi-Annual Report to Congress Regarding Public and Internal Use of Machine-Readable Data for Corporate Disclosures, the report concludes by saying the Financial Data Transparency Act directives coincide with internal commission and staff efforts to improve the management and use of data across the agency to work more efficiently. In 2022, the Office of the Inspector General of the Federal Reserve requested permission to use the EDM Council's Data Capability Assessment Model Framework to assess the data management readiness of the Federal Reserve System. In their concluding report, dated January 18, 2023, they endorsed the use of data management best practice as a way to achieve the mission success of the Federal Reserve, to foster the stability, integrity, and efficiency of the nation's monetary, financial, and payment systems. If standards is the hull of the ship, then data management is in the bridge. Navigate poorly and you won't get to where you're going, or worse yet, you'll run aground. punch holes in the hull and you sink. Data standards and data management must work together. Enabling this symbiotic relationship will not only enable a rapid response to financial crisis, but will also provide a proactive approach to identifying and addressing future financial challenges. So in conclusion, I'd like to commend the MRAC on their proposal to amend CFTC Rule 3919 to bring the U.S. regulatory structure in line with global standards by mandating the use of LEI identifiers at the beneficial account owner level. Thank you.
Thank you, John. I'll now open the floor to MRAC members for discussion. I believe, Marnie, you have some comments to share?
Yeah, thank you, Alicia. Yeah. JPM recognizes the importance of the LEI and as an FCM and provides DCOs a legal entity, LEI, where possible. JP Morgan is generally supportive of the LEI for compliance with regulatory requirements. However, consistent with the recommendation for the Commission to host a roundtable before the use of the LEI becomes a regulatory requirement, various challenges need to be analyzed and discussed, ideally with input from relevant market participants. For instance, further discussion and analysis is required to understand potential concerns of certain market participants, like retail participants and end users like farmers and ranchers who rely on the derivatives market, but may be negatively impacted by the cost and administration of acquiring and maintaining an LEI. Additionally, if the LEI shall be mandated, additional rule provisions may be needed to arrive at a balanced and sustainable implementation framework. Based on more than 10 years of experience with the use of LEI in CFTC trade reporting for swaps under Part 45, we believe such an implementation framework should address areas including the following: a clear regulatory obligation on the legal entity owner and controller to obtain, maintain, and pass on the LEI directly to the relevant registered entity, such that there is no obligation on the registered entity to remind the owner or controller to obtain, maintain, or pass on the LEI. Permission of the relevant registered entity to report LEIs that have not been properly maintained by an owner or controller. Permission by a registered entity to report an alternative identifier in cases where the owner or controller did not obtain an LEI or is unable to obtain an LEI, and establish a clear governance process that allows continued access to trading and clearing for an owner or controller who has not or cannot obtain an LEI or failed to properly maintain its LEI. It is JP Morgan's view that the wording, where available, in CFTC regulation should not be removed until these challenges have been discussed, vetted, and properly addressed. JP Morgan stands ready to participate in any discussions or roundtables to analyze and/or resolve these challenges related to implementation of LEI. Thank you.
Thanks so much, Marnie, for that comment. Echoing my earlier statement that conforming changes can be easily made to the report and recommendation, and we will include the written statements of members that submit written statements to be included in the submission to the Commission. I must now note that Marnie's statement might appear to be an amendment or a suggestion with respect to the proposed recommendations. So we'll ponder that on this side and attempt to address it just ahead of the vote, because I believe there are additional comments to be received. Thanks.
Thank you. I have a comment on behalf of FIA. FIA is supportive of entities trading in the futures and options markets obtaining an LEI. Given the LEI implementation experience in OTC markets, we welcome further dialogue to discuss the steps that would be required to be taken in order to have a successful implementation here. We note that although requiring an LEI seems logical, we strongly believe that many firms will be slow to adopt and some will not move forward at all, particularly absent an express legal obligation on the account owner and/or controller. We welcome continuing the dialogue in this issue with the Commission and other partners in our industry.
So at this point, we will take additional comments, but in the context of the discussion and dialogue, I would turn to the co-leads for the work stream, to ask if you welcome the friendly amendment to remove the language explicitly asking that we remove language from Part 39 of the regulation until such time as after perhaps the roundtable discussing this matter has been held. If you are agreeable and amenable to that amendment, we will amend the language in the recommendation, at which point we would proceed to a vote with this language that is amended, removing the suggested removal language from Part 39, or indicating by footnote that the MRAC CCP Risk and Governance Subcommittee will revisit following a roundtable the removal of the language. Dick, Alessandro?
Sure. The recommendation that we made contemplates the formation of a roundtable. We just want to make sure that that happens and have this robust discussion around these with a variety of participants.
Yeah, and also I believe that the latest version of the report reflects comments. So for instance, it clarifies that retail individuals are not required to obtain an LEI, but we'll go back and double check that to make sure that that is that makes it into the final version of the report.
Fantastic. So for MRAC members who will be voting shortly, to clarify, the amendment is to ensure language conforming to the suggestions made by Marnie Rosenberg of JP Morgan and Alicia Crichton of Goldman Sachs that would create a sequencing with respect to any specific consideration of removal of language from the specific regulation the CFTC currently has adopted and enforces. I do want to just clarify one other thing so that I can avoid being in trouble. By way of roundtable, we're referring to an MRAC-driven roundtable, potentially involving staff, encouraging, in fact, perhaps DCR, DOD, and other divisions of the CFTC to consider a commission-led roundtable. But I am not the chair of the commission, just the sponsor of this advisory committee. So therefore, all I can endorse and all we can do is suggest, and we'll clarify this language, is that MRAC will host possibly a roundtable. And to the extent the commission is open, we're prepared to support and encourage the roundtable by the commission. So with those two, one point of clarification and one amendment, I'll pass it back to the chair for further receipt of comments and a call to a vote.
Thank you. Are there any further questions or comments on these amended recommendations on legal entity identifiers at the beneficial account owner level? Okay. I'm sorry, Ty. Go ahead.
I'm questioning the need for this amendment. As Mr. Berner said, I mean, here in the report recommendation, it says not only to, get rid of this where available language, but then it says the subcommittee recommends that the commission host a roundtable to discuss implementation of this. So I don't see that this amendment is necessary. The subcommittee report language makes very clear removing the where available and holding a roundtable. So I don't know that taking out the recommendation of where available until the roundtable is held. This is a recommendation to the commission. The commission makes the ultimate decision, but the subcommittee has looked at this, and I don't think that the amendment language is necessary based upon what's in the report right now. So I would vote against this proposed amendment.
Jessica?
Yeah, thanks, and I apologize. I'm trying to be totally clear on what I am or am not voting on. And my interpretation is that the amendment suggests that members would not be comfortable with voting yes if that is currently in here and then just having a roundtable, as opposed to requiring a roundtable and further agreement and vote to determine whether that should be removed pending the amendment of additional language proposed by Marnie. So I think that is the difference there. And so for clarity, are we voting essentially to say, to vote that we approve moving forward to a roundtable that then will discuss the potential amendment to the language proposed that then will again be voted on to proceed, so that it is not just moving to a roundtable that then doesn't necessarily include that language?
So thanks so much, Jessica. To clarify, our procedure at this point will be to agree as a committee on the amendment. The amendment as proposed on the floor in the moment is that the committee would proceed to hosting a roundtable and/or encouraging the co-hosting of a roundtable with relevant divisions of the commission that would ultimately be responsible for rulemaking in the context of the specific amendments to the language suggested. That's the sole amendment that's on the floor, and that amendment does eliminate sort of one of the two steps of the recommendation. And part of that is to signal by footnote, I think it was decided in terms of the amendment that the committee would like to revisit the removal of the language after the roundtable has been held. I do take note of Ty's point. I take note of Ty's point, largely in that I think Alessandro has also indicated a tremendous effort on the part of the committee to reach consensus in the language that is in the report. And part of the effort to reach consensus was to emphasize a collective public-private dialogue through the roundtable ahead of encouraging the commission to take a specific action by way of amending the regulation. So I think Ty's point is a fair reading of the report, in part because I think there was a tremendous effort on the part of the drafters to find a place where the language in the report was such that the language on its own would have demonstrated the consensus of the subcommittee and potentially be amenable to the parent committee for a vote. But in the current moment, the vote for purposes of Jessica's question would be with the recommendation as amended being the focal point of the vote. So a vote in favor is a vote to move forward with the roundtable, with a caveat that pending the outcome of the roundtable, a recommendation would be made to the commission to amend the language in Part 39.
Again, are there any other questions or comments ahead of the vote on the amended recommendation?
Alicia, maybe I can provide a little bit more detail to build on what the commissioner was mentioning. So the tension here is, on one hand, to enhance systemic stability in a way by having more reliable data, whilst not creating an undue burden on FCMs, for instance. And so that's the tension that the drafters and the subcommittee were trying to address. And that's why in the report there's a reference to the various regulations around the world requiring use of LEIs. And so the idea is not to impose on the FCM a requirement to force the FCM's clients to obtain an LEI, but rather the beneficial owner has an obligation to obtain the LEI, and then the FCM and then the DCO use that LEI. So we try to bridge that, but it's kind of tough to do with also the commission, of course, doesn't have jurisdiction over absolutely every single beneficial owner in the world. And so we're trying to address that by finding the right balance. And that's also why at the end there was a recommendation to hold a roundtable, because these are very complex balances to achieve.
Chair Crichton, point of order. Are non-MRAC members permitted to make a comment specifically? Mr. Bottega?
Sorry, just confirming that. I don't believe you're actually permitted to make a comment. Sorry about that. Thank you. Okay. Just checking one last time if there's anyone on the phone or joining virtually, if there's any other questions or comments ahead of moving to the vote. Okay, seeing none, well then, we've discussed at length the recommendation and the amended recommendation on legal entity identifiers at the beneficial account holder level. Is there a motion from the body to adopt this amended recommendation and submit the amended recommendation to the commission?
I move to adopt the recommendation as amended.
Thank you. Is there a second?
Second.
Thank you. It has been moved and seconded. Are there any additional questions or comments?
So can you clarify, are we taking out the language in the proposal or not for the amendment on where available? Are we taking out where available in the amendment?
So Annette, I think at this point, we're modifying the recommendation on page 4 of 8 of the recommendations. It notes that the subcommittee recommends CFTC Regulation 39.19 should be amended to bring U.S. regulatory structure in line with global standards, and goes on to suggest in the subsequent sentence that we would be removing the where available language from Part 39.19 C1 Romanet 1A. I didn't want to do the rulemaking from this table, but our goal is to pull that specific language out to drop it into into a footnote that notes that the committee, the subsequent sentence says also recommends, rather now it would say recommends that the commission host a roundtable to discuss the implementation of, and then we'll bring the rule language forward and include a footnote that says for purposes of considering whether or not where available should be removed. In other words, a recommendation for a roundtable for potentially removing the language of where available.
Okay, thank you. Just from an operational perspective, I totally agree that LEIs are important, but we've got to streamline the operational effectiveness of obtaining and keeping on LEIs. It's very difficult right now.
Thanks so much, Annette, for the comment.
Are there any other questions or comments before moving to the vote? Oh, sorry. Yeah.
So we're going to remove this language, but is there a way to preserve, either in a footnote, that the original subcommittee report, which I believe it was stated was consensus and unanimous, recommended the getting rid of the where available clause? So is that going to be preserved here to say that the original subcommittee language recommended where available, but during discussion at the full committee hearing, it was decided to remove that and wait until the roundtable? So is that going to be preserved in the record?
Ty, I will hear your question as a statement and take your statement to further amend the recommendation, or more precisely, a point of information regarding what the amendment, how the amendment might read. Excuse me. I note that the suggestion, unless the co-drafters or co-leads for the drafting committee disagree, I note that the suggestion is consistent with essentially acknowledging the subcommittee's vote on this matter ahead of presentation of the matter to the MRAC committee was such that there was consensus or interest in moving forward with removal of the language.
Correct.
So
yes.
I'm hearing that as a statement and a friendly refinement of the amendment that's on the floor. Is that correct?
Yes, ma'am. Thank you.
Thank you.
Okay. One last check for questions or comments. Jessica.
Yeah, just very briefly, if we are going to make that very clear, I think we need to also make very clear, but was challenged by this specific feedback, and here is what that feedback was, so that it does not appear one-sided in the reason for going to the roundtable.
Thanks for that, Jessica. We're taking diligent notes. And in fact, that's very helpful. I should have clarified earlier, forgive me. Any of the statements, and I may have mentioned this, that are read into the record from members of the MRAC for purposes of moving to a vote or amending the language of the recommendation of the subcommittee will be included in the ultimate presentation of the recommendation, proposals, and report to the commission. So our goal is certainly to not just memorialize these in the context of the footnote, but also to distribute explicitly to the commission any support or dissent or points of information offered up by MRAC members in connection with the recommendations and proposals. So for purposes of calling the vote shortly, our chair, would you like to do the honors, or would it be helpful if I?
Sure.
Okay,
Yeah.
we'll restate what the refined amended proposal is with respect to this matter. So currently, we're voting on from pages 4 and 5 of the proposal presented to the IMRAC on recommendation of the CCP Risk and Governance Subcommittee Tech and Ops Workstream. In the recommendation specifically was previously worded to recommend explicitly that language stating that the wording where available in regulation CFTC section 39.19C1 Romanet 1A be removed. The sentence will be transitioned into a footnote that includes a reference to the fact that the subcommittee voted affirmatively to include removal of the language in the proposed recommendation to the commission, and the sentence that follows stating the subcommittee also recommends that the commission host a roundtable will now read the subcommittee recommends that the commission will host a roundtable, and the footnote would follow this sentence that indicates the footnote indicating that there had been support at the subcommittee level to remove the language would follow that final sentence. Hopefully that drafting on the fly was fairly clear to everyone. Please let us know if there are questions or concerns. Otherwise, we will call the matter to vote.
So again, on page 5, the subcommittee report currently says one possible way for CFTC staff to implement this recommendation is to delete the wording where available. So this subcommittee report does not appear to explicitly recommend getting rid of where available. It says one possible way to address conforming with the rest of the planet would be to remove that language. So again, I hate to belabor the point, but the subcommittee report does not explicitly call for the CFTC to only remove where available. It says one possible way to conform with the rest of the planet. So I just think that's an important consideration.
I think that's very helpful, Ty. I think the drafters would deeply appreciate your careful reading of the language, because I think they worked very hard to include language that was more inclusive in light of the proposed concerns expressed. However, I would suggest that we take 2 steps, Chair Crichton, for purposes of avoidance of doubt. The first is simply to vote on the amendment, and then if the amendment passes, then we'll vote on approving the amended recommendation. That would enable us to have some certainty regarding the MRAC's agreement that the amendment should be added to the language, and then certainty regarding the adoption of the recommendation as amended. So based on the assumption that there are no longer concerns regarding the refined amendment, I'll ask Danny to, well, actually, I guess Chair Crichton will lead the vote with respect to the amendment.
Yeah, I'm actually going to ask Danny to lead that vote on the amendment, right? Yeah. 2 separate votes.
Thank you. Our first vote will be on the amendment. Same instructions as before. Committee members, when I call your name, please indicate how you wish to vote. We'll start in person, and then for our virtual attendees, reminder to put on your video as well as your audio. With that, we will kick off the vote on the amendment. Alicia Crichton,
Yes.
Robert Allen,
Abstain.
James Andrus,
Yes.
Ann Battle,
Abstain.
Stephen Berger,
Nay.
Dick Berner,
Yes.
Graham Harper,
Abstain.
Lindsay Hopkins,
Yes.
Annette Hunter,
Yes.
Dimitri Kourousos,
Yes.
Ernie Conke,
Yes.
Andrew Nash,
Yes.
Jessica Renier,
Abstain.
Tyson Slocum.
Nay.
Moving to our virtual attendees, Edward Dasso,
Abstain.
David Horner,
Yes.
Eileen Keeley,
Yes.
Derek Kleinbauer,
Yes.
Chip Lowry,
Yes.
Craig Messenger,
Yes.
Marnie Rosenberg,
Yes.
Suzanne Sprague,
Yes.
Biz Chatterjee,
Yes.
Elizabeth Kirby,
Yes.
Dmitry Senko,
Yes.
I'll pause for a minute for any other committee members who might have joined the meeting late and are available to vote. Great, thank you. Chair Crichton, you have 18 votes in favor, 2 votes against, and 5 abstentions.
Thank you. So the ayes? Thank you. The ayes have it, and the motion carries. For the amendment, I'm just, and now we're going to move to a second vote.
Yeah, the amended subcommittee recommendation.
Yeah, and then on the amended subcommittee recommendation itself. So I'll hand it back to Danielle.
Thank you, Chair Crichton. We will now move to vote on the amended recommendation itself. Alicia Crichton,
Yes.
Robert Allen,
Abstain.
James Andrus,
Yes.
Ann Battle,
Abstain.
Stephen Berger,
Yay.
Dick Berner,
Yes.
Graham Harper,
Yes.
Lindsay Hopkins,
Yes.
Annette Hunter,
Yes.
Dimitri Karosos,
Yes.
Ernie Conke,
Yes.
Andrew Nash,
Yes.
Jessica Renier,
Yes.
Tyson Slocum.
Abstain.
Thank you. Moving now to our virtual attendees. Edward Dasso,
Abstain.
David Horner,
Yes.
Eileen Keeley,
Yes.
Derek Kleinbauer,
Yes.
Chip Lowry,
Yes.
Craig Messenger,
Yes.
Marnie Rosenberg,
Yes.
Suzanne Sprague,
Yes.
Biz Chatterjee.
Yes.
Sorry, can you repeat that, please?
Yes.
Thank you. Elizabeth Kirby,
Yes.
Dmitry Sneko, excuse me.
Yes.
Thank you. I'll pause for a moment in case there are any other committee members on the line that have not had a chance to vote yet. Thank you, Chair Crichton. You have 21 votes in favor, no votes against, and 4 abstentions.
Thank you. So the ayes have it, and the motion carries. The amended subcommittee recommendations on legal entity identifiers at the beneficial account holder level have been adopted by the committee and will be submitted to the commission for consideration. Moving on to our third subcommittee, the Future of Finance, we'll now hear a presentation from Todd Conklin, Chief Artificial Intelligence Officer and Deputy Assistant Secretary of Cyber, U.S. Department of Treasury. Todd.
Okay. All right, thank you again. Apologies for the false start earlier on the AI jump, but thank you again, Commissioner Johnson. I think we're about 20 minutes behind, so I do have a PowerPoint, but I'll move pretty quickly through the PowerPoint. There's a very comprehensive report that Treasury published on the issues I'm going to cover in this abbreviated version today on treasury.gov/AI. And then there was a tandem piece that many of the drafters that worked on the Treasury report also helped draft the CFTC Technical Advisory Committee report, report, which was published in May, so a lot of overlap. And John Bottega did a really nice kind of setup in his remarks. So much of the Treasury report that was published in March was at the foundation a report about data and data control and data management, and then we extended to cybersecurity controls around the data and IT controls around all of that, and third-party risk management vendor controls. So all of this is not new, right? All of those different controls and the regulatory infrastructure that exists does apply to AI with some modifications and extensions. And if we go to the next slide, one of the things we asked every single participant, of which we had over 50 financial institutions ranging from our smallest to our largest, was, is there anything in our existing regulation that inhibits your ability to innovate in this space? The answer was almost universally no. That being said, there was quite a few requests for further refinement of our explainability standards, but nothing inherently that inhibits the ability to innovate in the AI space in particular. And that's largely because the financial sector has been leveraging AI tools in the traditional sense for the better part of 2 decades. And that's what really came out in the Treasury report, is that the financial sector has been doing this and has been regulated for its AI use for almost 2 decades now. So our financial sector could potentially serve as a model for other sectors in terms of how we blend the regulatory approach with responsible innovation in the AI space. And specific to the cybersecurity use cases, nearly every firm we spoke with had a deep body of use cases around cybersecurity controls. Many firms specifically said that you can't run a modern cybersecurity defense infrastructure without leveraging AI tools, full stop, right? So it's been in use for a long period of time, lots of lessons to learn. The existing regulatory framework does seem to work fairly well with extensions to how we approach it from all the different verticals that I already mentioned. One of the bigger gap areas that we have, though, is fundamentally the data gap. Our largest institutions inherently are going to have more data than our smallest institutions, and over time, as that scales out, that potentially could provide a significant advantage to our largest institutions, and it already is in the fraud space. And that's something where we're going to launch a series of work streams with the sector and the other government agencies to try to close at least that fraud data gap at first. But many CEOs of small banks participated in the Treasury interview process leading up to the drafting of the report to really foot stomp the point that they're being inundated with fraud activity within their ecosystem, and they don't have they're not armed with enough developers, they're not armed with the IT stack they need, they're not armed with enough data they need, and that over time this isn't going to scale well. It potentially is going to lead to a consolidation in favor of our largest institutions who are able to take advantage of these tools for their own defensive purposes. So if we go to the next slide. Let's see here. So yeah, overall, in terms of, so traditional AI had been in use for a better part of 2 decades across the sector, especially in the cybersecurity and fraud use cases. The sector is a little bit more cautious in its approach to adoption of generative AI tools. Many of it's being leveraged for report writing right now, backroom functions, and those who are really scaling their use of generative AI tools are using a mix of in-house and third-party AI systems. And again, that contrast was very clear with the largest versus the smallest institutions when we asked for specific examples about their use cases around Microsoft Copilot as an example. Some of our largest institutions were working very closely with Microsoft, even in the development of Microsoft's Copilot offerings. Our smaller institutions were having trouble even getting a response from some of the sales teams to begin even the speccing out. So again, that contrast, very, very, which is not inconsistent with the contrast that's always existed in the IT, tech, and cyberspace between our large and small institutions. It's just further exacerbated in the AI space, again, because of that fundamental data gap that I keep foot stomping. So if we go to the next slide. So generally the threat landscape, we asked every institution that we spoke with, what are they seeing on the threat landscape? Most acute and what's new for them is the ability to mimic video and audio of customers. So many firms moved several years ago to authentication for voice and video for some of their consumer accesses, and especially for some firms, not many, but some firms for their high value asset customers tried to create a little bit more of a frictionless experience for those customers, and it's that sweet spot of customers who most often has that public footprint that the adversary is able to likely identify where that individual banks just from scanning online, which we heard multiple cases of, in addition to being able to easily mimic then that customer's audio and video, which was able to then get through the authentication. So our message coming out of the report is, up the friction level, especially for those high-value customers who do have that public footprint in your risk port planning. Expand that to include a view of how prevalent is the audio and video of this customer in the broader internet, and will it be easy for the adversaries and criminals to potentially mimic that customers, and if so, add some more friction to that customer's authentication process. So if we go to the next slide. We identified quite a few gaps within the report, many of which are detailed. I'll just pick out detailed here. I'll pick out a few of them. One was the definitional piece, and the U.S. government is guilty of this. The U.S. government uses about 4 different definitions of AI for its own internal use cases. A similar experience on the financial sector side, concern about different terminology, different definitions that are being used by the regulatory apparatus, and then almost every single smaller institution brought up the data gap with the fraud data aspect of it as being a significant issue for them that potentially could cause them to have longer-term operational consequences as the adversaries advance their use of these tools. And then heard a lot about focusing on the NIST AI framework. Many of our financials, almost all of them, are using the NIST AI risk management framework and trying to operationalize it. Some of them did claim that it was a little bit too high level to operationalize, so a lot of the work that we're going to work on with the sector is to operationalize that for especially our smallest institutions so they can have a very clear roadmap. If we go to the next slide. Just additional challenges. The gaps in human capital, not necessarily new. Again, that divide between the largest and smallest institutions, very, very big gap there. In addition to then untangling digital identity solutions. And this is something where we're going to, good question, I think from Jessica, and like, what is the role of cybersecurity? What is the role in this space, and how far do we extend what we traditionally do in cybersecurity and our cybersecurity vehicles to combat some of these fraud spaces? And that this is a new area of focus of us, of really honing in on what could digital identity solutions potentially look like to really help secure all of our infrastructure. So those are the 10 gaps we identified. We launched 2 months ago a series of work streams, public-private partnership work streams with the sector. So U.S. Treasury and New York Fed are going to lead work on development of an AI lexicon and terminology that ideally would be adopted then by the federal regulatory community. We're going to work that, much like we did with cloud, in total lockstep with the regulatory community and the IT companies and the financial sector so that we could all align on a baseline definition for AI and the terms underneath that. A heavy dose of fraud work streams. American Bankers Association is going to help lead some AI-enhanced fraud work streams along with Treasury's Bureau of Fiscal Services. Cyber Risk Institute has the lead for taking the NIST cybersecurity framework and then extending that to an operational roadmap for smaller institutions especially, and they have a consortium of large institutions that are going to help them do that mapping process. CRI did the similar work for us on cloud to great effect. PNC Bank is taking lead on development of financial services AI nutrition labels, so that gets to that third-party data ingest issue that our smaller entities are going to be very reliant on third-party, bringing in third-party data, how they secure that, how it's labeled for their use in AI models so that they can meet the explainability standards. All of that's going to be part of that nutrition labeling process that's being led by the sector. And our goal would be to create a package of information and requirements that we would then pass to the third parties for use when they're dealing with a financial sector customer. We did very similar work with cloud providers, and it seemed to work pretty well. And then FinCEN is going to help us with the identity and authentication pieces. So if we go to the next slide, there's multiple different elements of that work. And then we go one more slide. We're also then going to have BPI begin the work on explainability, what that looks like from a more detailed perspective, focusing not anything to the right of the model in terms of consumer-facing or decision, but to the left of the model. So how do you explain the model? How do you explain the data that's in the model? And that's where the nutritional label construct that PNC is leading will come into play really cleanly with that, so that our smaller institutions, if they are pulling in external data, will have a roadmap to be able to explain what that is to the regulators. And then our OCC is going to lead an accountability work stream pretty closely linked to the explainability piece, exploring what financial institutions need to do to successfully use AI models. And then our last slide is just our timeline. So all this work has already begun. It actually started in end of November. Our goal is to complete as much of the work as possible by the end of November of next year. So a lot more work to be done. Very excited to kick it off. And thank you to Commissioner Johnson. Appreciate it.
Thank you, Todd. We'll now open it up to MRAC members for discussion. Yeah. Okay, we're going to keep going. We're moving on to our fourth section, which covers matters relevant to climate-related market risk. We'll begin with a presentation from Sandra Lee, Deputy Assistant Secretary, Financial Stability Oversight Council, U.S. Department of the Treasury, on highlights from the FSOC climate-related financial risk, followed by presentations by Christopher Odenet, Professor of Law and Mosbacher Research Fellow, Texas A&M University School of Law, and co-reporter of the Uniform Law Commission Committee studying commercial law aspects of voluntary carbon credits, before turning to Kim Ratcliffe, Chair, U.S. Department of Agriculture Advisory Committee on Minority Farmers, to hear end-user perspectives on climate-related market risks. I'll hand it over to Sandra.
Great, thanks for having me here today. So before launching into a short overview of the FSOC's work on climate-related financial risk, maybe just briefly by way of background for those of you who are not familiar with the FSOC. The FSOC, our statutory mission is to identify, assess, and address potential risks to U.S. financial stability. And the committee is chaired by Secretary Yellen and has 10 voting members, 5 non-voting members. And the 10 voting members are basically the banking regulators, market regulators, and also we have representation from FHFA, CFPB, independent member of insurance, et cetera. So it's definitely spans the financial services regulatory community. So I was asked to come here today to talk about the FSOC's work on climate-related financial risk. So maybe just taking a step back, in October of 21, the FSOC published its report on climate-related financial risk, and that report included 35 recommendations to U.S. financial regulators on how best to identify and address climate-related financial risk. The report was the first time that the Council identified climate change as an emerging threat to financial stability. The report's recommendations broadly fall into 4 categories. First, assessing climate-related financial risk assessing climate-related financial risk to financial stability, including through scenario analysis and evaluating the need for new or revised regulations or supervisory guidance. 2, enhancing climate-related risk disclosures to give investors, market participants, and regulators the information they need to make informed decisions and manage climate risk. Third, enhancing climate-related data to allow for better risk measurement by regulators and the private sector. And fourth, building capacity and expertise to ensure that climate-related financial risks are identified and managed. Since the report's release 3 years ago, the Council and its members have made progress in advancing the recommendations identified in the report, including significant actions taken by members to address capacity building, disclosure, data, and assessment and mitigation of risks. To help facilitate these efforts, in February 2022, the FSOC formed a new staff-level committee, the Climate-Related Financial Risk Committee, or the CFRC, which serves as an active forum for interagency information sharing, coordination, and capacity building. We also set up the FSOC's first external advisory committee, the Climate-Related Financial Risk Advisory Committee, or the CFRAC, lots of acronyms in FSOC, that is composed of individuals representing a range of backgrounds. The CFRC, which is the Interagency Staff Committee, continues work to identify and assess climate-related financial risk. Recently, a subcommittee of that committee presented a preliminary set of risk indicators to the Council. This was very much an interagency effort to bring insights and data together to pool resources and avoid duplication of effort across the agencies. The risk indicators represent an important step forward to collaboratively assessing and monitoring the effect of climate-related financial risk on the financial system. That subcommittee developed an initial chart pack that includes about 30 metrics on physical and transition risk drivers, banking exposures, and the insurance market. The charts on physical and transition risk drivers include projections of areas with high natural disaster risk in the future, as well as shifts in the cost of energy production by energy source. The set of banking metrics in the chart pack included metrics that help to begin to measure how climate-related financial risks could manifest as traditional financial risk, such as credit risk, market risk, and operational risk. Initial efforts focused on exposure metrics that assess banks' exposures to historically high climate risk areas in their operations and lending portfolios as well. The set of insurance metrics consider topics such as protection gaps, premium rate changes, and the growth in state-run residual markets. As we have monitored climate-related financial risks, several issues have emerged as warranting additional areas of focus going forward. First, there remain concerns about how climate risks could affect insurance affordability and availability, as well as the potential for those insurance market shifts to impact the housing market. It's challenging to assess these risks given significant data gaps. While there has been progress to fill those gaps and build models to assess climate-related financial risk in recent years, more work is needed to increase data availability at a granular enough level, preferably down to an asset level, to support a rigorous analysis of climate-related financial risk. Two, given their critical importance to the broader financial system, we will need to continue to monitor how the banking sector manages its exposure to climate-related financial risk. Recent efforts by regulators have been important steps forward. Last fall, the banking regulators issued principles for climate-related financial risk management for large financial institutions, which is an important interagency step to support efforts by the largest financial institutions to focus on climate risk management. And earlier this year, the Federal Reserve released the results of its pilot climate scenario analysis, which has also been important, to enhance the ability of large banking organizations and supervisors to identify, estimate, monitor, and manage climate-related financial risk. We know we need to continue to focus on insurance and the housing market and the banking sector. But at the FSOC, we know we cannot focus on any one sector or market given the potential for climate-related financial risk to transmit across markets and through the financial system. It is necessary for financial regulators to continue to work together to manage these risks in the financial system. And the FSOC is a key venue for continuing to promote that collaboration. Thank you.
I just want to say thanks so much to Sandra for joining us, and congratulations on the FSOC report adopted last week. So freshly minted as we hear some details here. We have two final speakers. I'll let Chair Crichton move forward right away. If you'll just give them the benefit of 5 minutes each to speak, we'll close out as soon as they're done. But both have flown in from Texas. So I think that absolutely merits our undivided attention as someone who grew up in that great state. So.
Great, thank you so much. Chris, we'll hand it over to you.
Thank you so much for having me. I will be quick. Thank you to the committee members for inviting me. My name is Chris Odenay, and I'm a law professor at Texas A&M University. But I'm really here today because I was recently appointed as the reporter for a Uniform Law Commission project that is studying the commercial law framework around verified or voluntary carbon credits, including whether or not it would be desirable and beneficial to develop some model or uniform legislation on the matter. I want to start by saying that the scope of the CFTC's authority, of course, is broad enough to encompass verified carbon credits, either as they're currently operationalized and transacted, or as they may be in the future, which is to say that it's certainly a market that merits additional information gathering. And to sort of help with that information gathering exercise, let me first just frame my remarks by distinguishing, importantly, between two very different types of carbon credit markets. First is the perhaps more well-known, the regulatory carbon credits. These are created and overseen by government programs. And then the second are the verified or voluntary carbon credits, which emerge from private initiative and which are the sole focus of the Uniform Law Commission's project. I'll start just by saying a few things about the U.S. experience with regulatory carbon markets. They're pretty limited. It's the California Cap and Trade Program and the Regional Greenhouse Gas Initiative, which is a collection of about 11 northeastern states. Both of these initiatives operate through a system where regulated industries must obtain allowances equal to their carbon emissions, where regulated industries with those allowances authorizing the emission of 1 ton of CO2 or CO2 equivalent. Both programs also permit regulated entities to use offset credits, or what we will refer to as carbon credits, for a small percentage of their compliance obligations. And notably, both of those regulatory regimes specify that the credits do not constitute property rights, and they require that all transfers and trading occur through a centralized tracking system and with regulatory approval. Comparing that, turning to the voluntary market, again, that's the focus of our project. It's a markedly different landscape. The market is driven entirely by private initiative, companies, self-determined emissions reduction goals. The ecosystem here is also quite diverse. There are many actors, project developers who design and implement emissions reduction projects, reforestation being probably the most significant and well-known, independent carbon credit programs that develop standards and methodologies, verification programs that independently assess the projects. There are registry holders who manage the credit issuance, their tracking and their trading, financial intermediaries that facilitate that trading, and of course, the companies that use the credits, like airlines, manufacturing firms, and recently the social media giant Meta. What I think is particularly relevant for the market consideration is the current state of the private law framework in these markets, because unlike their regulatory counterparts, voluntary carbon credits really exist in a space where fundamental legal issues remain largely unaddressed, and hence the ULC's project. To give you just a few, one issue would be the precise nature of the carbon credits. Do they constitute property rights, or are they merely comprised of contractual relationships? How can these be effectively used as collateral in financial transactions? What protections might exist for good faith purchasers in downstream trades? How these assets should be treated in bankruptcy proceedings, such as in the case of the insolvency of an intermediary who holds the credits for others, and indeed what rules apply to the custodying of these credits, and how the transfer and settlement finality of carbon credits should be determined. I'll also note that there is quite a bit of international attention to this space, with investigations ongoing at the World Bank and in other fora. Also, as these markets continue to evolve and sort of progressively intersect with the traditional financial markets, the CFTC's and other financial regulators' oversight will become increasingly important to maintain market integrity. So I think just on time, thank you for your attention. I look forward to what I hope will be your continued attention and work in the voluntary carbon credit market, and the Uniform Law Commission welcomes your input in the process. Thank you.
Great. Thank you, Chris. Kim?
Thank you, everyone, for this opportunity. I should first say I'm here as a producer. I do chair the USDA Minority Advisory Board, but I am here as a producer. And I also want to quickly note that I was in the financial institution world for a long time, and I actually quit my job to come back to the ranch due to the disconnect. between the financial institution and the farming institution. So I'm trying to bridge that gap, and that bridging that gap is part of being on this advisory board, is how can we bridge the gap between the minority producers and the financial institutions, because I don't think we play a huge role in that institution right now. And just as an oversight real quick, just so you know what the advisory board really role is we are really here to make sure that there's a minority aspect in every USDA program throughout the whole agency. So that's a pretty big job, but that is our main role. But I'm really here today to really talk about the issues that are sustainably preventing producers to participate in these financial markets. So I'm really going to talk on a producer level, so I'm not going to really use financial terms, because I really want you to understand what the producer's thinking, because a lot of the times these financial terms are really discouraging for these producers. So there's a lot of things that are challenging for them, and one of them is access to capital. And I know that's with everyone, but it's really hits hard for these communities there. They can't adopt a lot of these practices that were just mentioned earlier. It's hard for us to adopt it because we do not have the funds to adopt these programs, which in return will not allow us to participate in many of the offset carbon that there is out there. There are programs out there that do help, like USDA and NRCS has these cost share type programs that do assist, but ultimately it's not enough for them to actually participate in a way that most producers can participate. Then there's also what we've been talking about. I do serve on certain farm credit boards with that access to capital. One thing we have been talking about is how can we use these offsets as potential loan opportunities. So that is a big topic within our industry, is how can we actually leverage it, because the number one thing we're afraid to do is lose our land. And when we have to put our land up for collateral, that's the worst thing that we have to do, especially in our minority community, because that's how we lost our land. So if we can figure out a way to get this access to capital another way, and this is a huge opportunity for us. Also, the other thing is the lack of standardization. Most of the minority producers are small. They're not large, and the large institutions and large operations are getting these practices done pretty fastly, and these small operations aren't. So I do collaborate with a lot of HBCUs, historically Black universities, and these universities are seeking to do these co-ops where we can bring these small producers together, and then we have the power of these small producers to actually go after things that more of the large producers can actually source. The other one that is when we think of large producers, we also think about how these large producers are getting these elective and unelective, I call them, because sometimes they say which one you want to go into, government or ungovernment type programs. And sometimes those small producers are neighbors and they can't participate, but they also have the same carbon as their large producers, and they do not get that opportunity. So we've been talking a lot on how we can intersect those two. How can they get the same opportunities as others? Another one is technology. Technology is really huge for us because we don't have the technology. So we've been working with a lot of, collaborating with a lot of institutions on how we can kind of bring this technology. We don't have precise technology like some of the largest ones that then gives them the benefit to participate in programs that the smaller ones can't. So how can we provide this technology to them? And again, it's working with these institutions and partnering with a lot of nonprofits to kind of get this going with them. And the last thing I want to give an example of, and it's probably a broad example, but I think it's worth talking about, is solar is huge for us in the small community. And I am a huge proponent of the solar industry, and we've actually just expanded our operation. We're one of the larger operations into solar. We put 1,500 acres into solar, right? But one thing I have pushed is that with us getting those 1,500 acres, our neighbors were able to actually produce in that solar. That's how the carbon needs to work. They're able to produce in that solar contract because of this one large contract, and they're able to expand their operation even more. So one thing I want to end with is that if this is, I keep preaching, if this is done right, especially when we talk about this carbon offset, it can really change a producer's life. Diversification in our operation is the most important thing. I came home because I can't rely on cattle just to make a living. Cattle industry is so up and down that if I relied on that, we're all going to go bankrupt in this industry. So diversification in this carbon offset is huge for us, but there needs to be some trust in our community, and there needs to be some clear understanding in that. And that is really what I hear from my community on a daily basis. So thank you for this opportunity.
Great. Thank you so much. I think that actually concludes today's meeting. I really want to say thank you to all of our guests today, and of course, our MRAC members. I think it was an incredibly productive session, so thank you for all of your time. I'll turn it over to Commissioner Johnson.
And I'll just echo the same. I want to say thanks to everyone who showed up today and who, all of you have been tremendously supportive across the last several years in terms of the MRAC recommendations, suggestions, proposals, and even just open discussion. The closing panel for today's dialogue demonstrates that there is so much more for us to do in the context of our service, thinking about market risk, thinking about climate-related market risk as sort of a new and next frontier. So I want to thank everyone who served, everyone who is here today in person, and those who joined us virtually. I'm especially thoughtful about those who were on the tarmac and had to join us from that space because the weather in DC prevented their ability to get here. We really are thoughtful about all of you. With that, I'm going to turn the meeting over. Let me pause 1 second. I do have to say really quickly, I won't list every name, but I'm thankful to the AV and IT and logistics teams that helped put together today's meeting. Without their help behind the scenes, nothing that we attempt to accomplish at the commission would be possible. So I want to acknowledge all of their help and support. And I also want to thank Chair Crichton, Alessandro Coco, and Danny and Chris, who are supporting me from my office in support as DFO and ADFO for the MRAC.
Thank you, Commissioner. Thank you, Chair Crichton. Thank you, everyone, for joining our last MRAC meeting of the year. The meeting is now adjourned.